Hello. Hello, my test. Okay. Can everyone hear me in the online? Hello, can you guys hear me? If let's say you can hear me, please help me type one at the chat box. Oh, we got a question here. Can you hear me? Yep. Okay, I saw everyone say yes. Yes, yes, yes. All right, then we should be starting our webinars here. Thank you, everyone. Yep. So, okay, moment, yeah. Okay, so good morning, everyone. So welcome to our webinars for today. I'm your MC for today. I'm Brian. You can address me Brian, or else you can call me Gafong or Gahong lah. Okay, so today our webinars or seminar session will be from 10 to 12. So today we're going to talk about FCPO and soybean oil lah. So by these two type of commodities, how you can doing make some profit from that. And yep, before I start, let me introduce you about our company, Philip Capital. But before we start our presentations, so here is some disclaimer here lah. Okay, so all the information here today we talk about here, no matter is me, Brian, or Mr. Ken, and now we talk about this is not your preference lah. If let's say you are looking for some advice from anything else, is looking toward to the finance or what, you should look for your own financial advice lah. So yep, so let me talk about Philip Capital first. So Philip Capital is a company that incorporated in October 1995. It's a very long company, and we are the first company who are offer futures in Malaysia. And we are wholly owned subsidiary of Philip Capital Holdings Sendirian Berhad lah, which means our company not just doing like stock, like CFDs, like futures. We do have some asset management, we do have wealth planning, we do have like mutual fund and so on. And previously we call Philip Futures, but as you know that currently we are called Philip Capital. Do you guys know why? Yeah, I guess nobody know. Yep, because previously we are just mainly focusing on futures and CFD. There's more toward to derivatives lah. But starting from last year, we merged with AIBB lah, which is Alliance Investment Bank. So we are start offering stocks products. So as you can see, we are the trading participant of derivative Berhad, of course, and also securities Berhad. So we are able to do both product in the same way lah. And lastly, we are the CMSL law. Okay, so for Philip Capital, we do have a nationwide branches. So you can see, of course, you are standing here, or no matter you are in online or what, you are standing here. So of course, we have a headquarters in Kuala Lumpur. So it's in Megan Avenue. The others one, if let's say the nearest will be Kota Damansara branch, which is my branch. If let's say you have anything you would like to know or what, you can drop by to our branch at Kota Damansara. Other than that, we do have Alosta Penang, Malacca, JB, Kuantan, Kluang, and also East Malaysia, Kuching, Cebu, and also KK. So I would like to take this time to gratitude about the supporting of all of our clients, or no matter you are clients or non-client, because we get a award winning from Busa Excellent Awards. We are from 2017 until 2022. So here is the things we get from the Busa Excellent Awards lah. And last year we did also become the first runner-up and also the second runner-up of best retail derivative trading participant, and also the best overall derivative trading participant. Okay, about our global network, because Philip Capital, if let's say you know about Philip Capital is our mother company is in Singapore. So after that, we move on to different country and different countries. So in what country you can find us? In, for example, like France, like Turkey, Dubai, India, Thailand, Indonesia, China, Japan, Australia, Vietnam, Cambodia, United States, United Kingdom, of course, our home country, Malaysia, and also our mother company, Singapore. So about our coverage, you might ask, what kind of futures that you are offering, what kind of exchange that you are offering. If let's say you are currently in joining in seminar, so inside the goodies bag, we have things called product list. So all of the products will be shown at that. So what kind of exchanges we do offer? Of course, Malaysia. Today we are talking about Malaysia and also US soybean oil futures, right? Of course, Bursa Malaysia we are offering. And SGX, we are offering all the CME groups like CME, CBOT, COMEX, and also NYMEX. We do offer with different exchange. They have like different kind of like characteristic. Like CME group more toward to like indexes, CBOT also indexes, COMEX. Then it will be gold, it like precious metal, and NYMEX will be some energies futures lah. And not only that, we also provide you the exchange from the Europe, from the Hong Kong, and also Japan. So Phillip Capital is your one-stop solution. Why we say so? Because we do offer three kind of products. First one is the futures. If let's say you are totally new to futures, today our topic is going to talk about the agriculture futures, mainly to the agriculture futures. But not just the agriculture futures, we do have index futures like S&P 500 index, like for Bursa one will be FKLI and so on and so forth. So metal futures will be very straightforward. Metal futures like gold, silver, and so on and so forth. Energy futures will be the crude oil. Like last year is a very good year for crude oil, as everybody know. Although there's some bad things happen in the world, but if let's say you are an investor, you always can look for the opportunities to invest in, no matter it's futures or what, and so on. And lastly, in the interest rate futures, it might be a very good futures as well, because we know that the Fed have been increasing their Fed rate in the past with very aggressively. So maybe it's the time to looking towards to the interest rate futures lah. So for the others one will be equity or call stocks lah. I just now heard somebody is fully trading in stocks, right? Yep. So we do have Malaysia shares, of course, Malaysia shares. And for the foreign shares, we do have 4 exchanges. The first one will be US, Hong Kong, Singapore, and also Australia. So the last one is a contract for difference. If let's say a contract for the difference might be how to say not that familiar with all of you guys, because contract difference is kind of combination of futures and also equities. Because for the contract difference, you can pay some margin in order to trade the stocks like futures. Maybe you can trade up to 10 times, 5 times, or 2 times. So you make a like something like a margins, but it's not margins. It's easy work on the maturity basis by month to month. So we do have Bursa share CFD, and also US share CFD and US index CFDs. So basically, here is the product that we offer to all of our clients and non-clients. Okay, why you should choose Phillip Capital as your broker? Of course, we are the award-winning brokers. The second one, we do have 24 hours brokering executive support. So if let's say you are trading in US counter, you might asking, oh, if let's say I have some question want to ask, who should I reach to? Yes, you can call our dealing desk, then they will be helping you at the time. So other than that, it will be advisory service. Because as I shown that in all of the Malaysia, we do have branches. If let's say you have some questions or some things you want to ask, you can drop off to the branches and ask them. They will be happy to help you. So the next one will be latest market news. So later I will share a little bit on the latest market news, wide array of products with different kind of exchange. We do offer wide array of products. And lastly, the online account openings. Okay, the next is we learn with how you learn with Phillip. Actually, there's not just the seminar like today. We do also provide a free one-to-one coaching section. If let's say you are totally new, you don't know what is futures, yes, do feel free to approach to us, because we do provide a free one-to-one coaching based on your needs. It's no matter it's an introduction to stocks, futures, CFD, or you want some more advanced like technical analysis or fundamental analysis, what you should looking to in order to invest and make some money from there. So there's a one-to-one coaching. The second one will be seminar and webinars, as everyone is joining here today. And lastly, the free account opening. Okay, so as I said just now, for free one-to-one coaching, we are mainly focused in the introduction to the products, product knowledge, of course, platform coaching. We do have our own platform. Maybe later I can brief you through about our platform. And also lastly, the charting system, which is more to technical analysis. So here is the QR code. If let's say you want to join our next seminar or webinar session, you can still scan this QR code, but no worries. You still also can go to our website and register there. And here is the market call. We will call it weekly market call lah. So we have two market call. Is both start on Monday. The first one, which is the market view and updates, they will be on every Monday 11:15 a.m. lah. So the other one is live counter technical analysis lah. So it's on 8 p.m. at the night. Yep. So here is the online account opening platform. So if let's say after these webinars or seminars, you are interested to start trading in futures, you just drop by to our website and just register there. They will guide you how to register and so on and so forth, no matter you are local or foreigner or what. Okay, so let me brief you about our trading platform. We do have few trading platform for few products lah. So for futures, we are mainly using Philip Nova. So Philip Nova is a platform that done by our Philip Singapore. So yeah, so you can trade over 90 indicators and buy and sell, market depth, and so on and so forth. So you can have a look here. So the next one is for stock trading platforms. Basically, we have two stock trading platforms. The first one is Philip Trade. Philip Trade is mainly focused on local stock, and the other one is Poems Global MY. They're mainly focused in those foreign stocks like US, like Singapore, Hong Kong, and also yeah, just these three. Then the last is the Philip CFD Trader. So this is a platform for the CFD trading lah. So you can trade the top 100 stock of Bursa, top 100 stock of US, and also the US indexes CFDs lah. Okay, so here's our some promotion. Let me just brief you through. So we have our year-long campaign, which is trade and earn with Philip. This campaign is like you trade more and you will get more rebate lah. So let me give you a simple terms lah. If let's say in a month you trade FCPO FCPO in and out, in total it around 30, which means one day you go in, the other day you go out, one day you go in, maybe in between sometimes you get in 2 times and get in 3 times. So when you trade more, you will get more rebate. So the maximum rebate we can provide you is 1,800 for this year lah. Okay, so if let's say you are very interested to start trading on try to get some vouchers, touch and go vouchers from this campaign, you can just scan the QR code or approach us. So the next one is mainly focused on the Singapore stocks. If let's say you are trading in Singapore stock, you will be entitled for this, no matter how much you trade. But the top prizes will be the iPad Pro. So the top trading clients will receive the iPad Pro lah. The other one will be picked randomly for the 300 ringgit vouchers for touch and go. And lastly, the CFD. So we have futures indexes. We do have US indexes CFD. So you can like invest in CFD for the US indexes as well lah, because the commission is quite low as compared to the futures. Okay, so before we introduce our handsome speakers right there, yep. So let me briefly introduce you about who is Ken Out. Okay, Ken futures trading journey has begun in 2010 after joining Association of Finance and Commodities Trader, which is AFSCT lah, in Singapore. So he elected as to serve the executive committee member, which is more toward to education from 2017 to 2013 to 2017, as currently serve as the facilitators of finance and commodities trader clubs, which is FCTC. Otherwise, in 2018, Ken joined Signature Link Capital as a full-time proprietor spread traders. So today we'll be talking more about the spread trader since he's kind of professional in spread trading, right? So focusing on intraday and short-term swing trading in commodities and equities futures lah. So he took on an additional role of trainer and speakers for Inspired Trading Solution in 2022. So without further ado, let us welcome our speakers, Ken Out. Moment I switch the slide for you.
Not so much. Not even in stocks. Okay. We ready with the slides, right? Yeah. Okay. So as usual, we have to start with the disclaimer. This is required. So whatever is presented here for purely for education only. I'm not instigating you to buy and sell whatever. And this if you need financial advice or that, you should look for a licensed one. I'm not licensed. Okay, I'm only allowed to trade, but I'm not licensed by security commissions over in Malaysia. Of course, then all the views shared here today will be solely based on my own capacity of what I do day to day. Okay. Right, a little bit more, which Brian, is it? Brian, yeah, Brian in touch on. Okay, actually, I started stocks as well, like most of you, some 30 years ago. So that's how far back I started stocks and Singapore stocks, of course. I'm a Singaporean. And basically, I was just punting. I have no clue what I was doing. It's just basically everybody says when it's cheap, you buy. That's about it. So yeah, that's how I started. And I was doing it for big, yes, sorry. This is my working place. Yes, that's right. This. This photo is taken in Singapore, but we have started off here in Malaysia already. So, yeah, I do, but we haven't got our floor space yet. We are just temporarily sitting on the second floor in this building. So yeah, that's exactly what I do. But we can talk about that later. Um, Sidetrack a little bit. Thanks to you guys for coming in person. As we were just chatting with this gentleman earlier, there is a difference between webinar and in-person seminar. There's a lot of things I can take it offline, but I can't do it online. So you guys are in for a treat. So later on, when this whole session is over and things like that, when we adjourn for our drinks and meal and things like that, we can chit chat. You can ask me anything under the sun when we are out there. So unfortunately for the webinar crew, webinar participant, morning to you, but you miss out. Okay. So back to what I was doing. It was 3 decades ago. I was just punting Singapore stocks, and then I only started when I switched from corporate role. Okay, of course I do it part time in the stock side. Then I was, of course, I lost money as everybody does, and then I went back to work. So I forgot about the market for a good period of time until I quit my corporate in 2008. Left my job without anything, and then I just come back home to Singapore and every morning, nothing better to do. Like what the gentleman said, nothing better to do. I power up my laptop. I was watching the stock market, just checking on the prices and things like that. Then I realized, hey, the prices are very cheap. So I was just wondering why. That was 2008. I didn't even follow the news about the financial market. So that period, correct. But I didn't even know because I was just working. I was just a salesman selling door locks and things like this. It had nothing to do with financial industry. I have no background in financial industry. So I'm a lucky few that able to transition into a new industry out of not by choice, but just by chance that I get into this. So I power up watching the prices, and obviously I have some saving and things like that, and I started punting again because I still don't know what I'm doing. When it's cheap, I just buy. And at that period of time when there's financial crisis during the kind of bearish market, there's a lot of volatility and a lot of bounces and things like that. So you buy low, you sell the next moment, that kind of thing. So well, profitable, very profitable. Then I realized, okay, this thing can be done. Probably it can be a career as well, my new career and things like that. So I started doing that. And then, like what Brent says, my future didn't start until I joined the association, which was set up by a group of ex-CIMEX, the Singapore Monetary Exchange, the ex-CIMEX traders who has transitioned successfully into the electronic trading. In the CIMEX floor, they were just shouting across one another using hand signal and things like that. Those are the time. Sorry. Correct. Correct. In fact, those CIMEX floor traders, they make their piles of money there. Because why? Because they are right there in the front of the market. They could see where the houses are going. They could see the big boys, whether they're buying or selling. So even if you don't know anything, when the big orders are coming in, you just follow along. You just have to grab one or two lots along with it. When they're selling 500 or 1,000 lots, that kind of thing, you just follow along with it. You make your money there. So a lot of them actually make their millions in the CIMEX floor. if you all remember Nick Leeson, the Rhodes traders from British side that came into Singapore, created a hoo-ha. From Baring itself, and it actually, thanks to him, it created quite a few millionaire because they were on his counter side of the trades. Okay, so let's proceed further. Let's talk about. So in most part of my trading journey, I was just a retail trader. Okay, with no cost advantage, simple platform and things like this. Then I started taking courses. Okay, in 2009 to 2010, I basically spent about more than 10,000 Sing just to sign up for courses to learn what trading is all about, to learn about TA and stuff like this, to learn about robot trading system where you buy when there's a buy signal, you sell when there's a sell signal, that kind of stuff. So I went through all those things. So, and for the bulk of it from there, when I started Future 2010, with the guidance from the association side, there are a lot of veteran there who but they didn't really teach, but they were just sharing how they do the trades and things like that, what you should not do and things, all these do's and don'ts, especially the don'ts. Okay, so being human, I listened to them, I understood what they were saying, but uh, as I was saying, '08 I was making money, right? '08, '09. In fact, I was in a good winning streak all the way to 2012. So I was making money and get ahead of myself. By 2014 or so, the WTI started to collapse, which I didn't even realize what was the thing that is coming. By 2015, I actually blew up again. So uh, in almost everything, because I was okay, this is something I have to take offline. Remind me when we are outside, we talk about the different asset, different instrument, CFDs, spot FX, and all this. Remind me when we adjourn towards the end of the session. Okay, I'll tell you more about those. Okay, so we jump next. So after this, we will talk about. Okay, I think we take a commercial break. So allow me to tell you a little bit more about our company, ITS. Okay, I have to operate two different screens. Okay, ITS, basically we are a spin-off from our proprietary trading firm, SLC, which is Synergy Link Capital. That's where I trade full-time in the proprietary trading shop. So as a gentleman asking me, what is a prop shop? Okay, basically prop shops are trading outfit that the traders are trading the boss's money or the company's money. So we don't fund in ourselves. We don't collect fund from external investor, things like that. It's all within the company. We were funded and we trade based on that. Okay, so this ITS was set up to take care of all other businesses of trading except trading itself. So as we keep the book clear and simple. SLC will be just purely trading, nothing else. ITS will take care of the research, the trading solution developments, the training, things like this. Okay, and the reason why we started this thing is because over the years there are many successful traders, especially the veterans. They had enough of their time, so they are retiring. I am derivative, fully derivative futures. Okay, so and that's where I switch from stock to futures. Okay, so offline you can ask me the difference between stocks and futures, which is riskier. Okay, in fact I can ask this also. Which one is riskier, do you think? Stock or futures? Who says stocks? Stocks. Futures. You don't trade. Okay, you said futures. Futures. Who said CFDs? Somebody said CFDs. Oh, you say CFDs. Okay, you say CFDs. Okay, future stocks anymore? Okay, so yeah, this gentleman is correct. Actually, stocks is riskier. Okay, why? Simple. One person in the company can make you bankrupt for whatever you invested in their stocks. One person who what they call misuse or abuse the fund, and that's it. You exactly. And being a shareholder, you're the last one to get your money. So you get nothing usually. So it's a lot riskier. Whereas futures, there's residual value. especially if you're talking about commodities futures. Commodity futures are physical item that the community needs it, right? For example, the soybean oil, you need it for your cooking. So there's always a residual value. There's always a market there. It's unlikely to go below zero. Now, correction, unlikely to go below zero. WTI went below zero, went below, I think, negative 40 or something like that. That's first time ever that a future contract actually collapsed below zero. System can't even track that. So a lot of people blew up because of that, because it's like 1 cent for crude oil, cheaper than my plain water. Well, of course, I'll buy. Yeah, actually went negative, and then you went into over loss, margin call, and that kind of things all start kicking in. So, yep, stock is riskier. So back to what we do. Okay, so when these veteran and experienced traders start retiring, nobody to pass on the knowledge. Okay, as we do a check earlier on, most of you are new. Okay, which is a good thing, because why? Personally, I feel that you need to learn trading, because it's a skill set that lasts you for life, to the point where when we got nothing better to do, we trade. To do what? To make money. That's it. So yeah, it's a skill set that keep you active. You can make money out of it, provided you know what you're doing and learn how to do it properly, of course. So it's a skill set that you must learn, regardless whether you want to do it full time or part time. It's good to have. So because of this, and especially in Malaysia, actually we started from Malaysia side. Okay, when we come to training and things like that, because we, after speaking to all these people, including the industry stakeholders, the exchanges, the brokers, Malaysia is shrinking in terms of professional traders. It doesn't grow. Okay, since I joined AFAC 2010 until today, which is 13 years later, okay, there is slight improvement current year or two. In the past, I remember when I was in the association, I know of there's probably about three prop shops in Malaysia, and it was still three along the way. Okay, these three survive, of course. They survive throughout, and they're still along the way, still three. So it just doesn't grow. But right now, if you're talking, including ourselves coming in right now, we are already an associate participant. We just got our approval from Bursa. And if I'm not wrong, we should have about easily 9 or 10 prop shop in Malaysia right now. So, and a couple of them are looking for traders. If you go to, I was told they advertise on Job Street and things like that. They were looking for full-time traders. So that's something you can consider as well. Okay, so because of that, in losing the professional trader group, we come and says that, okay, perhaps we should do something. We can share our know-how, hope to rebuild this group of professional traders in the view of nurturing and equipping you guys with the knowledge of how to stay relevant in the ever-changing market condition, right? So let me see. Okay, what else do I have to say? So for those who has attended my podcast, how many of you here attended the podcast before this? Oops, nobody. Okay, so you didn't get the question. Okay, in the podcast itself, I raised 4 questions. I can't remember the other first two, but okay, I think it's something like, have you wonder how what's happening behind the closed door of a prop shop? That was the first question, and then how they were able to, what is their successful formula? There was a second question which I answered, that you can revisit the podcast, right? It's still available, so you can go and hear it, replay it again. For the third question, basically is to how to stay relevant in constantly evolving market. Which and then the fourth question is that, is there a holy grail? Okay, these 2 questions I promised to answer today. So the first one, the first answer, the answer to the third question, how to stay relevant in the ever evolving market, basically is to trade in groups. Okay, simply trade in groups. At least a buddy. Find somebody to trade along with you. Don't trade on your own. Don't go solo, because trading is something which is very dry and boring. Okay, but it's the dry and boring stuff that makes money. Okay, take note of that. Is good in that sense. It's the boring method, it's the boring contract that you're trading that is actually keep giving you the cash income. Don't look for excitement. The moment you look for excitement, you are in for a treat. Market will treat you very well, give you a lot of excitement, and at the same time take the money away from you. Okay, so you trade in a group, something like what a prop shot do. You see, when you trade in a group, in that form, you could actually have someone to discuss trade with, someone to discuss idea. You can explore new ideas, someone to overlook you, because there's important part of trading which is risk, which you'll hear later on towards the end of the seminar today. So all this is why the proprietary shop lasted years after years. Is because we trade in a group, we share. And like this lady was just asking, is that my is that my office or something like that? Yes. I'm still having okay, I have 8 screen. Actually there are 10, but the other 2 are more for research. Out of the 8 screen, 1 is for risk management, the other 7 are trading screens, and then some of the screens are doubled screens. Okay, I have a 27-inch right now. I have to minimize my browser because there's so many contracts that I'm trading, so I just have to pack them in. Now, it doesn't mean I have okay, the number of screen doesn't relates to profitability as well. Okay, and we are humans. Okay, I'm a bit lucky. I have 2 pairs of eyes. Some only have 1 pair of eyes, but the 1 pair of eyes is sharper than my 2 pairs. There's no way I can look at 7 screen at the same time. Okay, in my spectacle another pair lah, so I got 2 pairs. I'm a bit lucky lah. No lah, I mean, I'm just kidding. Okay, so like I said, we only have a pair of eyes. So at any given point in time, you look at 2 screens possible, left and right. So what about the other screen? Because we trade in a group, somebody will be looking at the other screen, because we will just scan around our screen. At any moment, somebody saw something moving, shout out, hey, there's a trade going on here. Then I look into my screen. Okay, we could be trading the same contract. So basically, then I take a look. Or I park my orders, put in some feeder orders, 1 lot somewhere that I wanted, buy or sell, whatever. And then when the trade sound come, then I turn my attention towards that screen, whichever contract that is being traded, something like that. So, but I need all this portfolio of contracts so as to give me a buffer, because if you trade one single product, if that product don't move, if that market don't move, or if that market close for holidays, you got nothing now. So we need to spread our wings, we spread our net, cast our net wide, so that at any moment, if this exchange is on holiday, the other exchange is running. If this contract is not trading within this exchange, the other contract is trading. Something like that. You never know what's going to happen, right? Okay, so much. Okay, and what else do we do? Besides being full-time trader, as I said, we double up as what do you call trainer and speakers. Okay, we have assignment from the exchanges. Like this one, for example, is sponsored by CMB, and of course alongside Phillip Capital. This week is actually CME Agricultural Week. Okay, so in Singapore, there's a lot of events going on during this week, which quite unfortunately, Malaysia, I found out basically nothing happened here other than seminar like this. You don't get exchange event conducted here. But let's see, if you guys start trading it and then there's a volume coming up, exchange will be encouraged to come here and throw events and things like that, which is good place to get network and share ideas with like-minded traders. Okay, so we also conducted 2 master classes back in 2019 across the border, 1 each. We started in Malaysia, we have about 13 of them on board, and then in Singapore we have 6 of them on board. And until today, in the Singapore side, there are 3 of them is continuing after the program, after the courses that they have attended with us. They continue into what we call a mentoring program until today, basically. So from 2019, they are still trading with us until today. In Malaysia, we have one of the students actually join us as a trader right now, trading in our shop. Okay, so let's go into. This is a research part that we do. Okay, basically a bi-weekly macro research for CME called Fresh from a Trading Room, and then actionable trading ideas, on Trading View. And the next one is a monthly Asian focus or SGX Traders Playbook. Basically, all these material are done in-house. We have analysts to crunch through the number, to crunch through the market, and then give some case studies on the current economic events that is happening, some trade ideas to follow as well. All these are sponsored by the exchanges, CME and XGX, so it's free. So scan this QR code and then get yourself connected to our publications in your inbox or even into your mobile phone. All right. Okay, next we comes to so much for the commercial break. So now we come to the agenda for today. Okay, we start off with a brief market overview to see where the top 5 oil seeds are trading right now. And then we do a quick intro into soybean oil and palm oil. I'm sure palm oil, most of you are familiar, probably trading it as well. That's the beauty of Malaysia. Almost everybody that I speak to actually trades palm oil. This is fantastic. I mean, in Singapore, we have our oldest contract, which is rubber, which used to be a Malaysian biggest product as well, but now all the rubber has become palm. But over in Singapore side, if you ask anybody from the street, do you trade rubber? It's, huh? Rubber? What's rubber? I know I buy rubber, I use rubber, but I don't trade rubber. So things like this. Whereas palm, everybody here does that some point in time. Okay. So then we look into the special unique characteristic between these two oil. Okay, and then we look at term structure. Now, term structure is an essential piece of information for commodities traders and speculator like us. Okay, I will tell you why later on. And of course, we will look into the what, why, and how spread trading. Anybody of you doing spreads here? One spread traders here, two spread traders here. Any more? What are you spreading on? Or pump CPO itself, right? BOPO. Oh, so you do BOPO. Okay, good. So again, so what is the spread that you're doing? CPO. Okay, okay, cool. Yeah, which I'll tell you later on. Okay, let's move on. Then I will show you, I will illustrate to you how you configure these two contracts so that you can trade it as one product. Okay, and then with a simple trading strategy. Okay, take note. I say simple trading strategy. Okay, then for those, in fact, this one also benefit those listening to us online. Okay, something for you to take home. Basically, I would say, which in my humble opinion, it should help you in your trading journey, at whatever stage you are, beginners, midway, or already experienced and things like that. And probably is life changing to some of you if you can internalize it and then apply it to everything you do. Okay, we will see to that later on. And of course, we will wrap up with Q&A. And this Q&A doesn't stop in this session. Like I said, when we adjourn outside for our break and things like that, we can continue. And those are the things that I can take it offline. You'll get a lot more juicy things that I can share. Okay, go straight to the okay. Oops, my slide is not moving. Oops. I need some help here. Technical issue. The slide is not moving. Supposed to be this. Okay, I think there's a so yeah, correct. Yeah, correct. Okay. Okay, sorry. These are the top 5 oil seed by production volume. Okay, you may not be able to see it clearly. Obviously, the first one, which is the red curve, this one is definitely, oh, I need to send this side because the camera is there. Right. Sorry. Okay, the red color is the palm oil. Okay, the orange one, not so clear to you. Basically, this particular one here, that's soybean oil. And then you have the green color, which is the canola, and the violet color is rapeseed, and then last but not least, this golden color is sunflower. Okay, these are the 5 top major oil by production volume. So right now, yeah, okay, thanks, Dave. Whatever they are currently trading, this is about a couple of days back when I prepared these slides. Okay, it has already come off quite a fair bit from the war-induced mother of all rally last year. Okay, when Russia started getting into Ukraine. Okay, that was somewhere early February, March period where it actually most of the oil peaked at the ultimate high where palm oil, if you remember how much was palm oil trading outright? 8,000, yeah, is sorry? Last year, early last year. Okay, when Russia start their military operation and palm oil actually went to 8,000. No surprise. There are also a lot of companies and traders blew up at this price because you get margin calls, and if you're not well funded, you will definitely get margin call. Well, it's hovering around there. It's hovering around there. So I don't know because I don't have a crystal ball. I don't have a crystal ball. Uh, Yeah, if I know, I would have been very rich by now. Okay, but I'm still trading it. Okay, but we can talk about this later on when we go deeper into the session. Okay, so basically this right now you see, of course, when we put all the 5 oil together, it's a bit messy. But if you strip them down one at a time, all the rally actually started when COVID was announced as a pandemic. It was then that the whole all the oil market or basically every market actually rallies after that because why there was panic buying when it was announced as a pandemic, and then you have shelf being emptied, and then later on the COVID measures start kicking in. You have the lockdowns, you have the MCO, you have labor shortage, you have the factory even shut down, no one is operating, you have supply shortage, and then because of labor shortage, you get into supply chain bottleneck. I mean, even the Suez Canal get blocked by one vessel, the kind of thing for a month or two. So all these things start happening, and that's where the prices start rallying. Okay, but somewhere along mid 2021, the prices actually soften and retraces back quite a fair bit. If you look at okay, palm was a very sharp one that comes off. The soybean oil basically was here, and then it was in mid of 2021, the fella was just going lower and lower, somewhere till the end of 2021. Okay, so what happened here? Okay, basically 2021, as we recall back, if I remember correctly, there were talks about COVID being lifted and things like that, especially from the biggest importer of the world who imports anything and everything all at once. So, but never happened. That is China, of course. And because of that, then there's no demand and things like that. Price tends to soften. So commodity is always about supply and demand kind of issue. Okay. So, oops, my bad. Let's go back and okay. So after the retracement, then as we say that the tension between Ukraine and Russia start building up, and that's where it started the mother of all rally, especially the soybean oil that goes all the way to 90 cents. Okay, 90 cents itself here, US cents. Okay, where the pump goes to 8,000. Okay, why this happened? Okay, to be honest, I was caught during this period. I was caught short. Okay, why I was caught short? Because interesting thing is that when the tension built up and then Russia moved in, and when Russia moved in, I was looking at the palm oil market, very calm and peaceful. I was like, eh, palm don't react, so nothing is going to affect us. Probably too far away from us, so we are okay. But the it was a delay effect, and then it started to spike and start to rally. Why? Because then the talks about the Black Sea shipments, they were all blocked. no shipments are going out from Black Sea. Ukraine and Russia's biggest exporter for this sunflower oil. Okay, so basically that one get pulled off from the market. So naturally, shortage of supply, suddenly the price will spike. In commodity, usually the going up is very fast. The coming down is a bit slower. Okay, because it's demand and supply dynamic. The moment you have shortage of supply, people will just chase up the price. So got to be careful when you start trading commodities, especially if you're trading the spot month. Spot month meaning the first month that is available for delivery. Okay, that's why brokers usually prevent you from trading the spot month. Okay, I think we got to go a bit quicker because we only at slide 9. So in a nutshell, okay, then later on it started to cool off. Why did it retrace again? Okay, then you would know that there's agreement between Russia and Ukraine, brokered by United Nations together with Turkey. So they agreed allow shipment out from Black Sea. The moment that release only, price start to cool off already. And of course, you have weather that is affecting, you have resale, there is bumper crop harvest, that kind of situation. And one thing I forgot earlier, the earlier rally was also because of biofuel. Okay, these two oils are used to blend into biofuels as well. So US side start a policy that, especially the agriculture industry, all their heavy vehicles, their machinery and all that has to use renewable diesel, which is blended from the oilseed oil. Okay, so any questions so far? This is just an overview. Sorry. Well, they usually use one of these edible oil to blend into the what they call the diesel or whatsoever to make it as a blend kind of content. So you use lesser of the crude oil side and to blend it with this. So it has to balance off the market. Okay. Okay. Characteristic between these two. These are the top two. Two of them combined account for something like 2/3 of the world production of oil, edible oil. Okay, which is about 60% of the market share. And the interesting thing part here is soybean. Okay, of course, soybean oil come from soybean. Okay, they have to crush the soybean to get soybean oil, and they are measured in bushel. Okay, one bushel of soybean is about 60 pound, or we're talking about 27 kg. So when they crush this soybean, 44 pound of it will comes out as soybean meal, which is animal feed for the pigs and live cattle and things like that. Okay, which is a cheaper form of high protein meal for these animals. Okay, and then there's about 11 pound of it coming out as oil. So this interesting characteristic is such that if you have a high oil price, okay, if the soybean oil price is high, it doesn't necessarily encourage or stimulate production by the soybean guys, because if the meal price is lower, because they can sell for every bushel, they can sell 44 pounds of soybean meal and only 11 pounds of oil. They can literally dump the oil at any price. It's an excess. What they want is to sell the meal that they make more money off. So you have a high oil price doesn't encourage that. Neither do you have a low oil price and you stop production. No, they don't, because if the meal is still profitable, they will still keep crushing. They increase their crush rate. In fact, if the meal is very good and the oil price is low. So when they start crushing more oil is going to come into the market. And then when more soybean oil is coming to the market, it will bring the soybean oil price down. Okay, more supply, lower price, and that will disturb the palm oil side. Okay, although soybean oil is usually recognized as a premium oil. They are so-called a softer oil that they don't harden up at certain room temperature. Okay, whereas the palm oil will actually turn hard or harden, solidify at certain room temperature. So it's considered a harder oil. This is a soft oil, which is more premium. So the price is also traded a premium over palm oil. So you can say that palm oil is basically providing the price floor, okay, the base price for the edible oil structure. Okay, and of course, what are the uses of these two oil beside being a cooking oil, which is the main purpose and main use of it? It goes into almost everything we use in our day-to-day life, right? Our soap, our detergent, our shampoo, even goes into our cookies, our chocolates, and whatever you name it. But of course, then the other one that generate a spike in demand is the biofuel, as I was mentioning earlier. Okay. Let's see if I miss out anything on the characteristic. Yep. Okay. Good. Next, we goes into term structure. Okay. So what is term structure? It's basically a curve for the different future prices of different maturity at any given point in time. Okay. So it's okay, like you see on this chart here. Okay, all the dots are the respective expiration contract price that is traded in the market today at this current moment in time. So there is a price differential between the different contract that is being traded, and basically there are two types of term structure. One is what we call contango. Okay, what is contango? Contango is basically when the spot price, which is the first month price, if the spot price is traded lower than the future price, okay, the spot price lower than the future price, this is called a contango. What is the reason for this kind of curve, upsloping curve? Is simply because if you need to take delivery in the futures, when I produce it, I need to store it for you. I need to get financing to store it for you. I need to pay for the storage. I need to pay for insurance to protect your goods so that I can deliver to you in the futures. Okay, that's why this future contract is all about. So when you have this kind of situation, which is normal situation, when there's no high demand, market was just moving along, and then merchant will just buy what they need and then use what they need, and then when they are down, they run down on inventory, they just replenishes the stocks to make an order again, deliver in 3 months time. I don't need the supply now, kind of thing. But until the point whereby suddenly the plantation side, like for example palm oil, telling you that okay, there's a flood and there's not possible to actually harvest the fruits and things like that. So your yield goes down. So all these merchants will feel that, well, I will be having a very tight supply coming on stream, so I better bid up the price to buy it right on the spots itself, the spot money. So I need immediate supply right now. So when that happen, the price on the spot month is traded higher than a future month. So that is what we call a backwardation term structure. Okay, why this piece of information is essential for commodity traders if you are trading commodities? Because then it's actually an indication of the market sentiment towards supply and demand. Okay, what is the supply and demand situation? Is there a high demand or a low supply or both? That means supply is low, you know that from the plantation. They says we have no more labors to actually help to harvest this. We are not going to produce a lot more oil. And then there is a demand from the market because the market is booming economy. Everybody is eating out and cooking and things like that. So high demand, low supply, everybody will just buy up because I need the stock. So I will just have to pay up a higher price. So this will happen in backwardation. So this is the sentiment of the current demand and supply. And these two curves, contango and backwardation, okay, this is also backwardation, can transition between contango and backwardation. They do flip to one structure to another. So technically, there is still a third structure which is usually not spoken about, which is a flat term structure. So for the contango to transition into backwardation, it will go through a period of probably 6 to 8 months of flat term structure. What do you mean by flat term structure? It's something like you see over here. It's flat. It's just flat. The future price has no differential between the different expiration month. Okay, what does it mean? It also means that everybody is agreeable that is the maximum price that I'll pay, or that will be the minimum price that it will be sold in the market. So it becomes a flat term structure. Okay, don't worry about this. You'll get used to it as you started trading. Okay, this is a bin oil chart for the past 4 years, 2019. Yeah, past 4 years. Can somebody give it a shot to tell me what term structure is bin oil trading right now? Okay, this is a weekly term structure. This, you see the underlying price, which is the chart in the background. And all these hairy lines that come down, these are the term structure. Okay, so currently, what term structure is soybean doing? Anyone? Sorry? Backward, correct. It's backwardation. Okay, why? Because the spot month is higher than the future price. Okay, it's lower. This is very obvious if you see it over here. Okay, and this is where the period of mid 2001, when the rally is about to start to begin, and you see the rushing or buying in the spot month itself that pushes the price so high up. Okay, from the weekly you can see this. Okay, you can't really see the print. These are all different month of expiration. For example, for soybean right now, the active contract is May, should be over, should be July by now. Okay, so there is a July and there is an August, and then the next one is September. So and so on and so on. So the different in prices. The front month is a bit dipping into contango, but then the second and third month, okay, the second and third and fourth and fifth, or basically it's gradual, but you can see that it's in backwardation. That means there's still demand coming from the second month delivery. Okay, so okay, before I go into the trading part of it, okay, this is palm oil. Anyone? What structure is this? Sorry, flat. Okay, any more? Backwardation. Okay, it is also backwardation, but as this gentleman was saying, he was not wrong that he observed there is a flat structure at the back. Okay, um, it is still backwardation right now. Basically, of course, there are reasons where you know the latest one, of course, is the little boy El Nino is coming. Even in the edge, they were talking about next month. So we don't know whether that will come true, whether El Nino will really come next month. But if it does, then it's going to be a very dry spell, and that is going to affect your yield. And probably that is a reason why that the front month is holding up the high price. Okay, whether you will go 4,000 or not, I don't know, because then the market will trade and the market will decide where you want to be. But correct. Well, conveniently, yes. They will say that it's El Nino, but El Nino hasn't really sink in yet. Okay, correct. Water shortage is possible. Yeah, it doesn't rain that much, and then if you don't control the forest well, then the haze will come. In fact, it's very hazy today, this morning, actually. Yeah, yeah, it's a bit hazy. Correct. So correct. So all this can happen. Okay. So the market is holding the price. So that's why I say if you trade commodity, you need to understand term structure. Okay, it's a very simple thing. Yes. No, actually, most of the time should be in contango. But of course, this period, okay, very good question there. We take a look of palm in 2019. What structure is this? Contango. Okay, it was in contango. Why during that period it was in contango? Do you remember? There was ample supply in the inventory. There was millions and millions of tons sitting there. Nobody want to take the tanks of food and things like that. Some of them have to even dump the fruit and don't mill it and things like that. So because the price is good, everybody start producing. That's one reason. Or the weather is good, the tree just able to give you a lot more fruits and things like that. Your supply it was just there. And the characteristic of palm is that it can be harvested anytime throughout the year. Whereas soybean is different. Soybean is a cyclical crop. Okay, they have a planting and harvesting seasons cycle every year. And for that matter, if you trade soybean, there is a kind of trades that or I do, it's called seasonal spread trade. Okay, because these are cyclical crops. So every year is the same cycle. By springtime, they will start planning the planting and things like that. Then they will plant the seeds, and then by about somewhere in towards the fall, after the fall, somewhere in November, they start harvesting. So this kind of cycle, planting and harvesting cycle, where the major factor is weather, whether it's wet, whether it's dry, where how well will the soybean grow, and the yield that is going to collect from the acreage that they have decided to plant on, things like this. All these factors will affect the price, and the market will be speculating, especially towards harvest. If you notice right now, the wheat price has been spiking very, very high right now, simply because there was issue of harvesting or something like that. This is way below the average that they have been harvesting. So they are foreseeing a lower supply coming on stream for the new crops. So when the new crops is lower supply, people will start beginning up buying the old crops right now, because if I don't get the new crop, I run out of wheat. I can't produce my breads and things like that, or cookies or pastry or whatever. Then I'm out of business. So all these things pushes the price up again. So now from contango, it was for a while. Okay, of course, if you go further back, palm oil has been on contango for many, many years as well. It's only a couple of years that it goes into backwardation. One of them was the previous round was the last El Nino, which, if you recall, should be about 2015, 2016. That's when palm goes into backwardation as well because of El Nino. So El Nino and La Nina kind of cycle. El Nino usually has a cycle about, say, 7 to 8 years kind duration. It will come back every 7 to 8 years kind of things. Of course, not absolute numbers. So if you count from there, 2016 was where El Nino left. So now it's 2023. So it's about 7 years right now. It's about due just by the timeline to come back again to hit in our region for this weather impact. So sorry. Okay. Yes, yes. We have a software. It's our analyst that actually coded a platform that actually produces this. But you can do it yourself simply because all you need is the day-to-day or week-to-week palm outright prices. Okay, term structure basically looking at your outright prices of the different month. So if you take, let's say you want to take a weekly kind of term structure, all you need is Friday at market close. What is the settlement price of the different contract months? Okay, you just have to plot them into your chart. You just have to use Microsoft Excel. Okay, for me, it's very, very elementary. I can use Microsoft Excel, plug in the data every week, every Friday night. I plug in the data and use that to produce a chart. Then you will have already this curve being formed. Okay, assumingly this red dotted line is as of Friday market close. So we get this line out. Now, you saw the price of the underlying going up and down. Okay, the term structure follows. Okay, the term structure doesn't stay at this 2000 level and then the price goes up. The term structure still stay here. It doesn't, because then this is where it actually follow the specific particular contract, what price they are traded. So that's why it's being it will actually trade up and down. And so if you see, this is a weekly term structure. You see here 1, 2, 3, 4, 5, 6. There's 6 curve here. So it means these are the weekly term structure of the last 6 weeks, current and the last 6 weeks. So you see the term structure trading higher, trading lower. It can move up and down along with the spot month price that is going, or the active month price that is going. Okay, palm is the third month is the active contract. Okay, right now we are talking about June being the spot, so is you June, July, August. August will be your active contract right now. Okay, so in a nutshell, this tells you the demand and supply situation. And how do you convert this into trading? Okay, so basically, if it's a contango, okay, the front month price is lower than the future price, would you be safer to be on the sell side or buy side? Give it a shot. Okay, if it's a contango term structure, that means the spot month is lower than the future price. Okay, so when you have an upsloping curve, this is the, oops, sorry. Okay, this is a contango structure. The spot month is lower than the future, right? Will you be safer on the sell side or buy side? Who said sell? Sell, buy. You say? Oh, okay, sure. A contango structure, okay, where the spot price is lower than the future price. Will you be safer to be on the sell side or buy side? Lower. Huh? You buy. Okay, that is okay. So any more? Anyone want to give it a shot? Sorry. So you change your sell to buy. Okay, yours is buy. Okay, so in the end, all three are buy. Okay, it's actually safer to be on the sell side. Why? Okay, yeah, this is stocks. Because stocks you can only go long. You cannot sell short. In futures, you can sell to open. Okay, you did not hold anything. You can sell to open and you buy back to cover later on. Future, you can trade both way. You can open to buy or sell to open. Okay, we call it STO, BTO lah. Okay, so that's the advantage of trading futures. You have both way to trade. Okay, now the contango is, okay, let's go back to this one. Okay, the upward sloping curve, this one, meaning that the future price is higher than the current price. So as the back month traded, when the first contract expired, the next one take over as the lead of the curve. So what happened to the next month, the second month, this one? When this contract expired, can the back see? I think not so clear. Anyway, simply vision it as in, let's say the spot month is trading at $100. The second month is trading at $200. When the spot month expired, what do you think will happen to the second month from $200? Where will you be trading? Given everything is the same. Okay, market condition is the same, demand and supply is the same, nothing changes. All else being equal, the 200 will come down to 100 because the spot used to be at 100. The market willing to take supply on the spot, that's why it's called spot month, at $100. So if you're selling at $200, I'm not going to take it unless I want future delivery. I want you to deliver next month. Then I know I have to pay the cost of financing, the cost of carry, right? So I have to pay a higher price. But now it coming to spot, I want to buy right now. There's a lot of supply. If you still want to sell me at 200, I go to this other seller that is willing to sell me at 100 because previous spot was 100. So you are safer to be on the sell side. Okay. No. You of course you won't be selling at 100. I'm talking about you selling the second month, which is already at 200. You can't trade the spot month anyway. Okay. You are not advised to trade the spot month. So you look for the future contract. You are safer to be on the sell side. So now flip side, if it's a backwardation term structure, the spot price is higher than the future. Will you be safer on the buy side or sell side? Buy side, right? Because as the future prices traded, it will go higher and higher because there's shortage of supply or there is this really huge demand on the spots and things like that. Or you know El Nino is coming, the price is going to go up. So maybe that's the answer to you that will the palm oil go back to 4,000 maybe if El Nino really come. But the moment El Nino don't come, the fella goes back to 3,005. So again, this is trading. Nothing is absolute. Okay, remember that nothing is absolute. You don't want to go and anticipate the market ahead of the time. Okay, you trade it as the market present itself. Okay, you trade what you see, not what you think. Okay, right. So much on that. Okay, spread trading. To answer your question, what is spread trading? Okay, so basically spread trading is when a trader buy a contract and sell a contract. Okay, it's a strategy where you buy one contract. Stand this side. You have to buy one contract and sell one contract. So in simple term, which contract will you buy? The blue color line or the black color line? If you want to buy one contract and sell one contract, which one will you buy? This is just very simple. Nothing complex. Okay, in normal cases, you will buy the blue. Okay, because why? You buy the low, you sell the high. Simple as that. Okay, so this is spread trading, and this kind of pairing is not something whereby you can simply just pick any two contract and then you trade the spread out of it and things like that. If you can see some correlation and things like that, you can, which I'll touch on later on, the basis for a pairing. Okay, this kind of pairing can be of the same contract, of the same or different expiration month, from the same or different exchange. Okay, it can be this kind of combination. That means you can trade, for example, the palm spread itself, the calendar spread we call it. Basically, it's from the same exchange. Okay, it's just two different expiration month. You trade the August versus the September contract. Okay, that in itself is two different expiration month, but from the same exchange and the same product, FCPO. Okay, that is a spread itself. Okay, and how does this kind of spreading and arbitraging opportunity comes about? Basically, if you have say for today's example, obviously they are from two different production center. Bean oil is in the US side, mainly from the US side. Palm oil is mainly on the Asia side. Okay, the different in production cycle, there are time differences. Your currency itself, okay, one is denominated in ringgit, the other one is denominated in US dollar. Okay, then you have different weather patterns in the two different production center, the related but somewhat different kind of demand and supply, because then palm oil supply to a different market segment as compared to the soybean oil. So because of all these factors, it gives you the price that they trade itself individually will actually widen and narrow that create this spreading opportunity. Some call this arbitraging. So it doesn't matter as long as you know you buy one contract, you sell another contract. Blue color, yes. Blue color is palm oil. Yeah, this is in blue. This is in black. Yep, you're right. Okay, so now the basis for spread trading. Basically, two fundamental bases. One is what we call correlation. The other one is co-integration. Okay, correlation can be positive correlation. What do you mean by positive? That means to say, if the demand goes up, what happened to the price? Price also go up. So it's positive correlated. If demand goes down, price also go down. Okay. Negative correlation. If you trade commodities, okay, is denominated in US dollar. Okay. If US dollar goes down, what happened to your price of the commodity outright? Negative correlation. No, the US dollar goes down, your outright commodity price goes up because it's denominated divided by the US dollar. So if your denominator is smaller, your price goes higher. So this is something to take note if you are trading outright. Okay. How many of you actually do spreads here? Earlier, there are a lot more people coming in right now. Any other spread traders around? Okay. So what are you trading spread on, sir? CBOT, CPO, BOPO itself. Okay. Okay. Cool. What platform are you using? Trading platform? Poems Professional. Wow. Okay. Ma'am? Same. Also Poem Professional. Is it? Platform. Okay. Okay. Good. For those of you who trades or going to trade commodity outright, okay, please take note. It is priced, most commodities are denominated in US dollar. So you want to watch your dollar when you trade the outright because sometimes it's just because of the US dollar strength or weakness that move the price. Nothing to do with fundamental supply and demand. Okay, because you have something divided by another, and if the denominator is smaller, your number, the whole number become bigger, right? If your denominator is bigger, your whole number becomes smaller. So your outright price will move because of the currency. So you take note of that. So why we do spread? Spread take away the currency effect. So there's no currency effect when we do spread. When you buy one leg and sell the other leg, because you buy a currency, you sell the other currency, the currency net off. There's no more currency effect. That is purely the supply and demand of the fundamental market, the underlying market. So that's why you want to do spread. You have no currency factor. But this case, BOPO spread is different because then you have one denominated in US dollar, the other one denominated in ringgit. So you have both side exposure or one side exposure at least on the ringgit side because of the difference in currency, right? You cannot eliminate the currency effect. So sometimes your spread points doesn't make money, but your currency make money, you still make money. Okay, this is beauty of doing spreads as well there, which I'll show you why we want to do spreads after this. Okay, so negative correlation like gold. When the US dollar goes down, gold goes up, right? When US dollar strengthen with the interest rate hike and things like that, gold goes down, right? Of course, these are just references. It's never an absolute thing that when US dollar go down, you better go and buy gold. No, gold also can go down. when it's a collapsing market, anything will all go at once. Everything will go down. Okay, even your crypto can go down as well. So please take note of this. Or there's no correlation at all. So no matter what happened, there's no correlation. The price won't go up, the price won't go down. There's no big spike in supply, no big spike in demand, things like that. Nothing works between the pair. So you don't want to trade a spread that there has no correlation because you can't find a footing. Okay. Now, co-integration. What is co-integration? In fact, this is more important. Okay, for spread traders like us, we want to, beside needing to find one of these so that you know which side to stand on, you also want to know this co-integration. It is a measure of the tightness between the two contracts. Give an example, which one of my boss used, which is very nice. If you walk your dog, okay, on a leash, okay, there is a certain distance that you set your leash. Okay, two of you are randomly walking down the road. Okay, then the dog saw something, saw a cat or whatever. The fella chased after him. The leash gets stretched, right? So it was constantly at different pace, but somehow the distance was the same because of the leash. Okay, the distance is the same. But then suddenly the dog rushed out. So your leash actually extended longer. So what will happen after that? The fella don't just run out and stay there. Once the cat runs off already, the fella come back to you again. So the leash come back. Of course, it's stretchable. You can actually reel it in and things like that. So basically, what I'm saying here is the distance between the two of you, it stays constant most of the time. But the moment one goes out of line, it tends to come back as well. And this is where one way of trading spread is what we call, the method is called mean reversion, relative value, mean reversion. So if it stretches too far out, it comes back to the mean again. Okay, there are contracts that are like this. You have to go and find out, especially those that are always on contango, for example, like one of them I can think of, which I'm doing, is the XGX rubber contract. Is almost, for the last 5 years that I'm trading that contract, it has always been in contango most of the time. The front few months can go into backwardation, but the rest of the curve is always in contango. So when it's always in contango, if it goes out of whack, I will just have to sell the high, buy the low, and the fellow will just come back to the mean kind of thing. So it's a no-brainer kind of trade. You just park your margin there and then just take your profit as it comes. Okay. Don't worry, you have your slides. You will get all your slides. You can request from them. The slides are available to you. Yeah. Okay, so why we trade spread? What is spread? You have already know. Okay, trading, buying and selling one contract. Why do we trade spreads? Okay, the advantage of trading spread. Obviously, lower margin, especially the calendar spreads. Apart from palm butterfly, is, to me, I still complain that the butterfly is still more costly. If you trade the CME contract, the outright is a certain margin, let's say $2,300. You go into a spread, it's probably half the price, $1,000 over dollars, something like that. If you go into a butterfly, it's probably about half of that $1,000 over dollars, maybe about $600-700, because it's a spread against another spread. That's what a butterfly is all about. You are doing more legs, and your risk get lower and lower when you already have a hedge. You buy one side, you sell one side. If the market goes up, your buy leg will make money, right? Your sell leg doesn't make money. Okay, but if the market goes down, your sell leg make money, your buy leg don't make money. But net you still make money. Okay, later on you see from the next slide, which is why I say when we trade spread, beside the lower margin and the lower risk, you have more ways to take profit. Okay, which I'll illustrate later. And then also you can have, with the rightful platform, you can get an alternate route or an alternate market that you can trade. Okay. So now, when you do a buy spread, you expect the spread to widen. Okay, meaning to say is that, okay, the front month here is denoted by the blue line. The far month is, the back month is denoted by the red line. So as long as, the most ideal, of course, you buy one side, you sell one side, right? Your buy leg goes up, your sell leg comes down. That's the most ideal. And when that happens, is exactly this first scenario here. The buy leg goes up, the sell leg goes down. The spread widen. You make money on both legs. This is the most ideal, but rarely happen that way. Usually because it's in the term structure, right? The term structure has a curve. So when the front month goes up, the back month also goes up. Okay, the curve will just follow the the underlying price. Okay, the whole curve will move up or sink along with the spot month price. Okay, because of this, if the spot month goes up, the back month also follow to go up. But it's just the magnitude of move. So the difference in the magnitude of move, it will give you something like if the front month goes up faster, shortage of supply, high demand, the front month will spike. But the back month, because it's back delivery, future delivery, it doesn't move as much. So because of that, your spread also widen. Or if a bearish market scenario, your back month collapse faster. That's why you see is in what they call backwardation term structure. The back month is flat. The back month literally don't move. Or when it goes into a contango and then it's going to flip into backwardation, the front month got bought up, the back doesn't move, or the back can sink very fast, so that the front month still at the same price of the market acceptance, but the back month, the future delivery, nobody wants the future now. Everybody wants the current one. So the back month just sink faster than the front month. You also make money from it because you have a sell leg that makes more money than your buy leg. Your buy leg will lose money. So one of the leg will be losing money, the other leg will be making money. Okay. And net, you will still be profitable. So there's three ways when you do a buy spread. Similarly, there's three ways to profit when you do a sell spread. Same thing. This one, you just want the spread to narrow. Okay. When you do a sell spread, you sell leg, you want it to come down. You buy leg, you want it to go up. Okay. The most ideal case, right? But it doesn't happen this way all the time, of course, and not for all kinds of contract. Most of the time, it's this kind of scenario. You will still make money out of it. And that's why we want to do spreads. And okay. Don't worry, you will get the slides. Just ask Philip for it. Okay, so even if you miss the photograph, okay, we are just halfway through. What is our time check? Am I? Whew. Wow, I talk too much. Are you all in a hurry to go anywhere? Somebody say yes. Maybe you didn't hear what I said earlier. So this is just the formality part, and also for our webinar attendance audience. The juicy part is when we finish this and we go outside. That's the juicy part. You can ask me anything. It's offline, okay, non-recorded. Okay. Okay, as I said, if you use the rightful platform, okay, the platform that I'm using is a professional platform, of course, which what we call trading technology, TT. For that matter, Philip Capital is the only one in Malaysia that is currently supplying this platform. No other brokers has it because it's very expensive. Okay, but they have I believe, because of our, I would like to believe, give me a bit more, our company a bit more credit, because of us coming into Malaysia, because we use TT back in Singapore. All of us use TT. So yeah, sorry. TT Pro. TT Pro. Okay. Sorry. Yes, you have an ADL that you can do your own programming, create your own algos and things like that. Very basic, simple stuff, not anything complex. Sorry. Yes, it's costing right now in Singapore is about $1,575 per month before market data. So my trading platform will cost me about 2,000, including market data, is about $2,002 a month. Okay. Yes, it is. And okay, this is something again, will be a barrier, I'm sure, because 2002, I haven't even make money. I got to pay 2002. Of course, for the start, I would not really encourage you to go there unless you already have a foundation of some profit that you can spare and things like that. Then you can actually come into this. Otherwise, you want to start with a lower version of it, the transactional model, they call it. They charge you by per lot you trade. So if you trade lesser volume, you don't have to pay 1,005. You pay whatever that is due. Okay. But that transaction lot is about US 50 cents per lot, which is about what? 250 ringgit per lot. So, and when you do spread, it's two lots. So, yeah. So the alternate, quickly, what is the alternate market? Okay. This is the exchange listed spread of corn contract of 3-month butterfly. 3-month butterfly means my front leg is a 3-month spread. My back leg is another 3-month spread. Okay, so this is 3 months September. Okay, meaning my September December spread is my front leg, and then my December March leg will be my back leg. Okay, so if you queue on the exchange price ladder, basically if you queue to sell at 1375, basically the exchange will leg these two contract for you. Okay, so you get your fill at 1375 on the spot, nothing more, nothing less. Okay, there's no risk there. And then for us, because our platform allow us to create synthetic, I'm actually creating another trading ladder. We call this a ladder, which is identical to this, but you can see that the bid ask volume is different. Okay, the bid ask volume, okay, conveniently is actually identical to the outright leg here because it's implied from the outright, meaning my platform can leg the spread for me. They will buy one leg. Once the leg is bought, they will sell the other leg. Okay, these are run by algos in the background. It's provided by the platform, something that I uses a lot. Okay, this become an alternate market that nobody else see. And many a time, I get better price from this alternate market than the exchange listed market, especially for CPO, okay, which I uses a lot on it, CPO and rubber. Meaning that if the CPO is trading at, selling at 4,000 right now, I could probably buy one tick better than the market. Okay, the market just doesn't go there. The market is still trading offer at 4,000, but I'm able to buy just one tick better. Okay, 4,001. I can buy that price. I can sell that price because I leg the outright leg of sorry, not 4,000. The spread will be trading at say current one, the active month should be about 35 or something like that. So yeah, I was able to leg. Okay. Right. This is the beauty of the platform that we pay for. Lah. So so much of the positive, the advantage of trading spread. What is the disadvantage of trading spread? Obviously, because it's spread, your fee goes up. There's two leg, buy leg and sell leg. You pay twice. Outright only pay once. So a lot of traders will think that I rather pay one than pay twice. But you pay one on the outright side, you get whacked most of the time. Okay. Whereas on the spread side, I'm steady. I'm cool. Whether the market is the index side is a big rally in US side or whatever, my spread stays the same. Next morning I wake up, I still can see the spread at the same level. It doesn't run away. That's also the advantage, even though I pay extra fees. Margin offset, spread like BOPO, there's no margin offset because it's two different exchange. You pay the outright or both sides. So there's no margin offset. So your cost is higher. Okay. Each one is about 10 to 11,000 ringgit per contract. Okay. And then you have what we call paika, okay, in the Hokkien term, which is you have a handicap. What it means is that because this feature of the alternate market, I'm legging in my spread. So I will buy one leg first before I sell the other leg, or I sell the leg first before I buy another leg. So there is a period where the market is very volatile. You get one side, you miss the other side because the market moves. So this is in a proper term, it's called slippage. Okay, your spread price, there will be a slippage. Okay. And of course, as I said earlier, there will come a point in time, all correlation is out of the door, like dollar sing, gold sing, crypto sing, index sing, everything also sing. So there's no positive, negative correlation. There's just no correlation. And then the usually co-integrated product just start tearing and then never come back because they just divorce and just go separate way. So that can happen as well. So these are the disadvantage of trading spread. Now going to the proper stuff that we have for today's subject, inter-exchange spread trading. Okay, it's basically the same, still a spread trading strategy. You buy one future contract and sell another future contract of the same or different expiration, but definitely from two different exchanges, but traded as one contract. Later on, you'll see how you can configure that. Okay, so these are the contract that we are talking about. I uses September as a reference. The spread formula is always similar. You take the front month contract, the front contract minus off the back contract, you will get a number differential. And that number differential is what we call the spread points between these two contracts, and you trade this spread point as it is. Okay. Now, of course, we need to go into the contract specification. Oops, contract specification. What's important to know? You want to take note that soybean oil doesn't list 12 months of the year. Okay. Whereas palm is 12 months of the year. That's why you have July, August, September, October, missing the November kind of thing. So preferably you want to pick the same month. So at least the weather is a lot easier to gauge the weather condition. It's a lot easier to gauge the supply and demand condition of the mass market kind of things. Okay. So, and also you want to see contract size. Okay, contract size is important because when you have contracts like this, different contract, your contract ratio, whether you trade one contract versus another contract, are they contract size equal? If they are different, then you may end up trading this kind of synthetic spread with, say, two of soybean, one of palm, or five of palm, three of soybean. The kind of contract. That means five contract. You have to long three of soybean and sell five of FCPO, something like this. This is denoted by the contract size. Okay, trading hours very important, as you can notice here. Palm oil, crude oil, palm oil, crude oil, blood. Okay, bean oil traded longer hours, whereas palm oil has breaks in between. So because of this, you can only trade the palm oil hours because these are the hours that will fall inside here. So you don't want to trade it outside palm oil hours. So you don't want to park your order there when the palm oil market close. You can get few on your soybean leg because it's still trading, but the palm has already closed. So this is important. And obviously you need to know your symbol. Daily limits. Now, when we trade commodities like nice to trade, very readable. You can have a lot of news out there in the market. Everybody receive it almost about the same time. Different from stocks. Stocks usually an insider or somebody who has more money to buy information. They get the info faster than you or things like that. The hedge funds especially. Whereas the commodity wise, if the weather change, everybody knows the weather change, that kind of thing. If you follow the weather, if the crowd is here, everybody can see the crowd is here. So there's no real that much advantage. Of course, the big fund will still have money to spend to really study into 3 months down the road how the weather is going to be, how the weather pattern is going to be. There are people providing this kind of services. So uh, these limits will be important because then you don't want to have a limit up situation or limit down situation, meaning that the market open, they just have a spike in price that traded at a very high price, and because it triggered the limit where the exchange has set, the price stays there. It cannot go any higher for a period of time. So if you happen to be selling the contract, and then there is a certain drought that is there is a certain strike that is there or whatever, the spot month price will just spike up so high that hits the limit and it stays there at the limit price. So you would actually technically has to buy back at that high price because you're already wrong. You want to cut your position and get out because they can still limit up again a second day. And some contract, when they have a limit up, that limit up is for the day. The exchange is closed. And then the next time, especially the beans, if I'm not wrong. And then the next day, because of this situation, the strike is still there. Next day, it limit up again, another 10, 20% higher. And if you don't cut the first one, which is cheaper, very painful, but it's cheaper because the next day is going to be another 10, 20%. Third day is going to be another 10, 20%. You're going to blow up your account if you keep going limit up. There are people actually got into all these situations. So commodity, as nice as it is to trade, be careful with this as well. Okay. I think this year POC or last year POC, there were a lot of limit up days as well because of the war. Okay, margin, as I said, this one is not corrected. I think palm is 9,000 now, right? If I'm not wrong. Okay, so this is, and this is still 2003. So you need to know your margin to capitalize yourself appropriately. Okay. Now, constructing this BOPO spread, you need to do this. When we do inter-exchange spreads of different contract size, different denomination, things like that, you can do it in two ways. I show you two ways here. One is the same denominator, US dollar per metric ton. Okay. Ringgit is ringgit per metric ton, right? Soybean is priced at US cent per pounds. Okay. Palm is ringgit per metric ton. So we need to convert these two contracts with a common denominator into US dollar per metric ton. Okay, how do you do that? Assumingly, bean oil is traded at 52.75 US cent per pounds. Okay, so to change the pounds into metric ton, basically you have a multiplier factor of the 2200. Okay, and then this is just to change from cents to dollar. Okay, you multiply, you get a price in US dollar metric ton as 1162.94. Okay. Don't worry, all these slides are with you. So you just have to listen in and understand how this flow goes. Palm oil basically quoted example 3619. Okay, and it's already in ringgit. You just need to convert the currency, so you divide it by the exchange ringgit to dollar exchange rate. You get your US dollar per metric ton as well. So the spread formula, the front contract minus off the back contract, which means you take this amount, deduct off this amount, you get your spread price as 347 and 35 cents. Okay, and this is the price that you are trading. It becomes one single number that you're trading. Okay, whether you feel that this is cheap, you buy. If this is expensive, you sell. Okay, simple as that. Now, the next way to configure it is by notional value, the contract notional value. Earlier, you see that soybean is per contract is 60,000 pounds per contract, whereas palm is 25 metric ton per contract. Okay, so this is 60,000 pound, 25 metric ton. Similarly, at 52 3/4 US cent, okay, you find what is the notional value. Basically, you just have to multiply, convert this to dollar and multiply the actual contract size, 60,000 pound. You get a price of 31,650 per contract. But what is the margin required? 2,300 to trade this contract. So this is the benefit of futures. Okay, benefit, and also it's a double-edged sword. It is also the risk you have. You put up a small margin of $2,300, you can carry a contract that is worth $31,000. It's a leverage instrument. Okay, you can go into overloss when you are trading leverage instrument. Now, palm oil, same example. You convert it to US dollar, you will end up into 20,389. Okay, spread formula: front month minus front contract minus the back contract. You will get your spread point, which is $11,260 different between the two contracts. So graphically, how does it look like between these two way of calculating it? Okay, this one is by US dollar per metric ton. This one is by, I'm sorry, the font is a bit too small. This one is by the notional value. So in general, when you when you look at this, basically the chart looks almost similar. Of course, the notional value has some slight differential over here, probably because of your currency exchange, because I'm using one exchange rate throughout this whole example. When you use the exchange rate, when exchange rate changes, you need to change as well. Okay, so in a nutshell, everything is the same. Okay, the current spread price right now, if you're talking about metric US dollar per metric ton, is somewhere around 52. I think as of yesterday should be they could have broken the 50 cents already. So this crucial level that I was watching, 50. The soybean oil has broke below the 50, so this thing should be the low 300 region. In terms of notional value, you're talking about 11,000 and a high of 20,000 differential. To me, is that I'm not so good with math. So if you give me a big number, is like I got intimidated by it. So I like to see a smaller number. So I will prefer to use the US dollar per metric ton. So what is the difference? Okay, the difference is if you use the notional value, every point move or every dollar move is exactly your P&L. So if it move from 11,200 to 11,201, you make $1. Very clear for your P&L. This guys is a bit different. Okay, this guy is that every point move will roughly give you an average of about $25. Okay, reason because then your metric ton is different. The soybean oil is about 27.2 metric ton, and then the palm is 25 metric ton. So there's 2.2 metric ton more in the soybean oil. So you're not apple to apple, so to speak. There's a slight differential in the weightage of the two contract, but it's so small that we can still trade it as 1:1 contract. You just have to know your P&L will have a slight differential. So don't be shocked when sometimes you say, hey, come today I make more money for the same spread point that I trade. The next day I'm losing a bit of the profit itself. Is because it depends on which leg move more, which leg is giving you the profit. So your P&L will actually have a slight differential. It's not consistent $25 or in the notional value. If you make $100, it's $100 flat. Okay, clear? Okay, we can ask the question later on. So now, earlier, this is a September contract, as I was saying, as an example. If I break it out into, there's a continuous contract. That means it links up all the years. If I break it up into the 6 years, you can actually observe that for the 2018, okay, there is a period of time that the contract trade in a range. Okay, these are the outright legs. This is the spread chart itself. So that's why I said once you configure these two contracts, you will end up trading just one single product. Okay, just like any other trade that you are doing. It's one single product, one single chart that you're seeing. Of course, your platform has to allow you to do this synthetic spread and then give you a synthetic chart. Okay, because if your platform don't give you an overlay and things like that, you can't get into this chart and you can trade off this chart itself. Okay, you see from this 2018, it was fairly range bound during this period. So like I said earlier, the simple way of trading it is you buy the low, you sell the high, because it's behaving in a very co-integrated manner. It doesn't run out of line during this whole period of time. Okay, you buy the low, whether you buy the extreme low or you buy somewhere below or you buy somewhere here, which you, if you draw support and resistance line, this will be your support line which you'll be buying, and then this will be a resistance line that you'll be selling. So simple as that. You can actually trade it. Similarly, for the subsequent year, 2019, there is also a range there, probably wider. Don't worry about the absolute number. It's the range that they are behaving. Okay. And of course, you don't want to trade into the spot month, so the front, don't bother about it. Usually, the front bits of the curve or the tail end bit of the curve will actually behave a bit more wild. Whereas from 2020, 2021, and no, sorry, this is 21, 22, and 23, current year. Okay, it's looks more like directional. So basically, it tells us that you can actually trade with a method of what we call mean reversion. Okay, relative value. If one goes out too far, you sell that fella. One goes down too low, you buy that fella, that kind of thing, to trade it back to the mean. Or the other way to do it is to look for directional trade, which most of you would have somewhat know how to do this through your TA chart reading kind of thing, candlestick and things like that. You can actually do directional trade. You don't want to, you can still do mean reversion, not that you can't, but in this kind of situation, or any market for that matter, any contract that you trade for that matter, whenever you get into a very volatile situation, very volatile period, what you likely want to do is to stay light and then nimble around. You trade around as quickly as you can. You don't want to leave your money on the table and exposed to overnight risks and things like that, which you may get limit up or limit down kind of situation happening. Okay, so that's why I do intraday, intra-session as much as I can. Okay, so next. Okay, this is the simple part. The trading part is the simple part. Okay, I say simple. I didn't say it's easy. Okay, it is very simple. You buy low, you sell high. But how low is low? How high is high? Is a question. Or you could also sell high and you could also buy high and sell higher. You could sell low and buy lower. It's also possible. Okay, but how do you denote all these things? It all comes in through experience, through over time of trading it, through understanding the contract per se, through observation. Okay, there's a lot of our trade sometimes. Okay, because then you as you can see that I have so many screens. So sometimes when the market is so quiet, every market is quiet, I will just be staring at my screen and then I'll just be looking at the numbers flashing here and there. And if you ask me what you're looking at, I say I don't know what I'm looking at, but I'm just blank stare at the screen. But as I blank stare at the screen, as I see the price move, somehow over time, of course, this takes a long time to come up to this kind of able to trade in the zone, so-called. You're in sync with the market. So sometimes if you just watch it and it's not going anywhere, it's just tick around 2, 3, tick up 2, 3, tick down, that kind of thing, and then it just stays there for weeks. It has always been there. So for me, is I cannot remember numbers that well. I'm not so good with math. So I actually pull out the chart. When I pull out the chart, I could actually look back. The chart will actually print how tight the range it has been trading. So if I can see any contract that is trading in a tight range, then it's straightforward. You just have to do it. When it's low, you buy, and high, you sell. That's about it. Okay. So the simple part, this leg has to be leg in. So you need a platform to allow you to buy one side first before selling the other leg, or sell one side first before buying the other leg. Okay. Later on, you'll see the example of this as well. Trading platform, like I said, with what we call an auto spreader functionality. Okay, you just have to set this thing up in the synthetic ladder, and then you just park your orders, and it will just work on its own. Okay, but these days, exchanges are trying to squeeze more money out of traders now. They are trying to control this. Okay, while they allow high frequency traders that disrupt the market, they trade in and out, they always squeeze in front of you, the kind of things. They allow those guys to continue to strive because they pay a lot more. They are higher volume than us. They allow that, but they don't allow us to use auto spreader because they say we have an undue advantage over the retail. Then what about those guys that has an undue advantage over us? I mean, they don't take care of us, the kind of situation. So they are starting to charge if you quote and re-quote too many times per session or something like that. And this can be very costly. It can cost you thousands of dollars per month extra cost paid to the exchange because you keep quoting and re-quoting. Because we want the spread point. So the algo will just keep looking for the spread point that we want. So as a market move, the algo will also move along with the market. So the spread point stays the same. If I want to sell $1, the algo will look for $1 spread differential to move along with the market. But the outright price has already run. So we need to recode that kind of thing. So that situation will cost us money. So of course there is a way to so-called beat this. But the way to beat this, we end up having a higher chances of slippages. Okay. But anyway, that's for some other time when we go into the detail of it. During active and market volatile period, yeah, the risk of slippage is always there. Method, as I mentioned earlier, relative value or directional strategy. Relative value means mean reversion. If it stays out, you want to trade it back into the mean. Okay. Then time frame. Okay, for me, like I said, intra session. If I can, intra session meaning pump open at 10:30 in the morning and closes at 12:30. Within the 2 hours, I want to look for trade within the 2 hours. I will close out my trade before pump close at 12:30, something like that, intra session. If I can't get out, then I do intraday. I have to go for the afternoon session when it open, try to get out before 6. If I can't get out, then I hold it to the night and start 9 to 11:30. Try to get out there. But of course, the actual contract date will start 9:30, okay, in the evening. So if you open your trade at 9 at night and hold it to next day, it will still be considered an intraday trade all the way to next day 6 o'clock. Okay, this is one whole day. Okay, this period. So now I'm forced to actually stay awake to watch the market at the evening market. Usually I tend to sleep at about 9 p.m., 10 p.m. I was already in bed, but now I have to watch it to 11 because of this pump market that is available. Okay. Next, okay. To help you to improve further, to fine tune how to do mean reversion. That's why I say how low is low, how high is high, the kind of situation. You can add in what we also use, Bollinger Band or Heikin-Ashi candle. Are you all familiar with these two indicators? Okay, I see a lot nodding head. Okay, very good. Then it can quicken my pace. Okay, is that all? Yeah, that's all. Okay, so in terms of my trading screen, this is how you will look at. You will see these are outright leg, soybean oil, pump. This is the synthetic, this is a synthetic, and this is another synthetic. Okay, these are the outright legs. Okay, ignore the outright legs. Okay, the three synthetic. This one is US dollar per metric ton. This one is the notional value. Straight off, which one would you prefer? Notional value or common denominator? This is the common denominator, BOPO. This is notional value. Which one would you prefer and why? Between this one, this ladder, and this ladder. They are all the same product, BOPO, bean oil versus palm oil. Anyone? Both okay. Wow, that's good. I personally prefer the one in the middle. Why? Bid-ask spread narrower. This one, the bid-ask spread is so wide. Where am I supposed to quote? If I want to sell, where do I want to sell? If you're going to sell right at the market, best offer, you can never get your trade. You can sit there the whole night, whole session, whole week, you'll never get a trade. Unless the buyer pay up all the way there. that means it runs you over. That means there's already a rally in price. So you may not, by the time the market rushes up, you may not want this price anymore. You say, no, I want a higher price because you are buying up. You want a higher price. Then you'll never get your trade. Okay, so it's things like this. So, but of course, then as you trade, you know the behavior, you will probably can best guess where will be the fill, because even though the bid ask spread is so wide, when the next trade that comes in, you can actually count how many tick they will pay up. Okay, per point move is what we call per tick lah. Okay, how many tick will they pay up? Like for this, for example, because of the narrow bid ask spread, if I put in the middle, okay, I'm okay to sell. I'm okay to sell. If you can't see, for 349.7 or buy 349.7, then I'll just put my buy or sell order there and wait to be filled. Okay, I don't chase the price. I will not take the offer. Neither will I take the bid, because unless I'm very sure the market is going to collapse the next very minute, otherwise you're going to lose your edge. Okay, as trader, you need to keep your edge as much as possible. Okay, even one tick is extra money to you, so you don't want to give away the edge. Okay, so this is the situation. I would prefer the narrower bid ask spread. Now, what is the difference? Actually, they look so identical. Okay, the difference is, remember earlier I said this US dollar per metric ton, your P&L is not very consistent. So there's a way to do it, is by the platform allows you to calculate and add in a multiplier factor. And that multiplier factor, when you apply to the legs of the contract, it will give you exactly the absolute P&L price. So if I want $25 per point move, then I have to add in the background, in the formula, a multiplier factor for each leg, so as the tick size will move accordingly. Every point move will be a 25 US dollar. We are not going to get there because it's a bit more complex, and I already be frank to you, I'm not so good with math. This is something which the analysts do it easily for me. I just have to improve my price, and then I get my multiplier, I enter in the platform. As simple as that. Okay, next, time frame. Trading time frame is an individual preference. Okay, but because I trade intra-session, I need to go on a lower time frame. So, but when you go on a lower time frame, what is your trade-off? Your trade-off is your TP range will not be that great. You have to accept that you are trading a narrower range. Okay, this is 3 minutes, 15 minutes, 60 minutes, and daily. Of course, the higher time frame is the best because it is less noisy, and is the move is actually more what they call profound in that sense. So the print will be a bit more relevant, because within the day itself, even if it's a down bar, the fella just don't go down from start to open. The fella will go down, bounce up, goes down, bounce up, goes down, bounce up throughout the whole day before it closes down. Something like that. So the day will give you a very good solid print, but intraday you can get a lot of trade out of it. That's why we trade intraday, intra-session, because we trade full time. So every time I'm on the screen, so I want to look where I can collect $50 here, $100 there, that kind of trades. So at the end of the day, it accumulates to my P&L bottom line. Okay. So so time frame is individual preference. Of course, like I said, when this one seems wide, okay, but the low here is about 338, and then the high here is about 344. So we are talking about just $6 different. It's a very narrow range. Whereas this one, if you see this daily chart long bar, this is about 322, and the high here is about 366. So you're talking about $40 different. Okay, the day chart you get $40 different. This one is only $6 different. So from the high and the low of this session. So it's individual preference, how much money. I have no problem if I can catch the $6, probably the $6, I can get a $6 sell, I can get $6 buy or whatever, something like that, which if it bounce around the whole day, I also will collect something extra as well. Whereas if you start waiting for the trade to come to you on the day, you may not even get a trade that day. That's the thing. Okay. So now how do you improve in this? This is candlestick. Okay. This is candlestick. Lots of gaps. Honestly, those who have learned TA, you look for patterns. You look for what they call shooting star. You look for whatever pattern names that you think of, flag or whatever, triangle, whatsoever. it doesn't seem to see anything on this kind of chart. Okay, so what can you do? We add in indicators. Okay, as some of you already use these indicators. Bollinger Bands are usually quite um, popular with spread traders because Bollinger Band supposed to measure the two bands supposed to measure the overbought oversold region, and it's actually more for meant for mean reversion trading, which is the center line here, which is actually a 20 period moving average. Okay, and then a two standard deviation from the moving average. Okay, they are just two plus minus two from the moving average. So the simple way to look at it is you buy the low, you sell the high. Okay, but there's one thing about this Bollinger Band which I uses it also. In fact, this is very applicable for stock trading as well, which I used that the last time when I was doing stocks. I would like to look for period whereby the Bollinger Band actually squeezes itself, okay, into a very tight range. Like for example, this situation here. From a wide range, it comes. I may have missed this. Okay, if I'm not gutsy enough, say I don't sell this high because then this one can go higher. So maybe that day I wasn't in my right frame of mind. I didn't want to sell it, and then later on it shows me, oh, it goes all the way down. And then when it come all the way down, I was like, oh, it moves so much already. Maybe it doesn't have strength to go up. I didn't want to buy. So things like this will be something that you always go through in your mind. All right. But when the Bollinger Band actually squeezes after the widening, it comes to a narrow range, especially if it stays in a narrow range for a while. What will happen next? It has to open up because you can never stay in narrow range all the time. The market will never be in agreement all the time. That's why there's a market. Buyer will think that I need to, this price is too low, I want to buy. The seller will say this price is too high, I want to sell. So there's always a buyer and seller in the market. So the market will have to move. So whenever it comes into narrow range, you be prepared for the next move. So now the tricky part is the next move is going up or going down. I don't know. I wouldn't know. Okay. But over time, when you trade this contract, because when you set this kind of contract up, you will also see the outright legs. How are they trading? Okay. Because this is BOPO. So your bean oil is a leading leg. So if the bean oil is rallying upward, obviously you want to go long. Okay. And this is not candlestick anymore. This is Heikin-Ashi. Okay. That's why you don't see the gap anymore. Heikin-Ashi actually closes all the gap. It takes away all the gaps. It's calculated in such a way that it prints. In fact, all these long bar here are all covering of gaps. Okay. You may not get the high price or get the low price that you want, things like that, depending on which direction it's trading. And Heikin-Ashi is actually a measure of a range of price movement. It's different from candlestick. Candlestick will print every single price movement. If it moves $1, it prints the $1. Whereas Heikin-Ashi doesn't really print that dollar. It's an average formula. And after it collect a series of price movement, a range of price movement, it print next, and it print next, something like that. So you can read all this thing up from the internet actually. How many of you uses ChatGPT here? 1, 2, 3, 4. Yeah. ChatGPT is something that you want to look into. It is scary, but it's amazing. Okay. You can even ask the fella how to trade BOPO spread. It will come out something for you. Okay. But of course, the cutoff date, I think, is September 2021. Anything after September 2021, he has no information for you. He's collecting all the past data, all the past searches and all those things and come out with the answer for you. And yeah, it's quite accurate actually. It can. Yeah. Sorry. Oh, forecast, of course, they can't. Yeah, they won't give you the forecast. But the beauty of it is, you ask the say, okay, how to trade BOPO spread? You come out with some explanation. And you say, can you write me a code to trade BOPO spread? The fellow will tell you, okay, because I'm a robot and things like that. But then after that, you give you all the codes. The codes will also come out. Yeah, so you can actually take the code and start trading. But of course, don't do that. You need to be very familiar with all the coding and all these things before you can actually apply. But ChatGPT really is amazing. So all this information which I just shared with you, if you forgot, you just go and ask ChatGPT. Before ChatGPT, of course, we ask Google. Everything you Google, the fellow comes and tell you with a lot of selection. But this fellow will just give you one straight answer from all that he has collected. Okay. So back to Heikin-Ashi. So it gives you the price range before it print. So in a way, when you see a down bar, a red bar, a down bar without upper shadow, okay, it just shows you very strong bearish momentum. Likewise, the other side, if you see a green bar with no lower shadow, it's just a very strong uptrend that is going. So the thing is, you can actually jump on board after 1-2 print. You can jump on board and catch the ride. Okay. Again, this is very easy on surface when we speak. It's like, so simple. Yeah, but is it really that simple? Of course not. Okay, you need to trade it, you need to observe it, you need to feel, because like I said, not all prices you will get the feel in live environment. You can play with simulation. Simulation will always give you the feel. And that's unrealistic, because when you go live, hey, how come I park here, I never get my order? Because the market never trade through there. But simulation, as long as the price is there, it gives you the trade. So give you a fictitious idea that you actually in the trade. So that's why when you trade simulation, your P&L is very nice. But when you go to live, oh yeah, okay. So you can add in, like I said, Bollinger Band. Basically, if it goes higher, you sell. If it goes lower, you buy it. Now, this is the one that I was talking about, trading along the band. Okay, obvious. There is slight narrow stretch here. Okay, this is 15 minutes. With number of bars here is quite a good period already. And then from narrowing, where does it goes? Oh, wow, skew. Bless you. Okay. So after it narrow, it will widen up, okay? And so that's where usually the first widening, you may miss it. But we know we want to, let's say if it's from here, it start to widen up, we want to look for long, okay? We want to look for long. This one seems like a very strong confirmation of long. And then you will look for price to jump in long. You may get few, and then you get into trouble because the fellow don't want to go long and come back down. This can happen. This is trading, okay? There is no such thing that you go long, the market will give you the long, okay? But if let's say you miss this, then you know it's going to go back to the other side, okay? You go again. You just have to go again. Now you do the short side. After a strong bearish momentum, you do the short side, okay? And then now you've been rewarded because the fellow just keep going down. Things like this, okay? So probability, right? Next, okay. Trading is also about not just must always do something, must always buy, must always sell. A no trade is also a trade plan. You decided not to trade. You are not sure, stay out. It is also a trade plan. Okay, please take note of that. So don't chase the trade, or don't just take trade for the sake that I've sat here for 3 hours and I still don't make money. Okay, I take the next trade, whatever comes. No, you don't do that. So when you are in that situation where when you're not sure, neither here nor there, you're not in the zone, what do? Change your perspective. Because if you keep looking at we call this myopic view, very narrow view, very narrow time frame, you get crowded. You are not sure whether it will go long or go short. But then if you step back, open up more data, okay, wider view, probably it gives you a different perspective. Change the time frame, it gives you a different perspective. So when you change your perspective, your trade plans also change accordingly. That may help you. Okay, so take note of that. And if these things still don't work, if the candles or the Heikin-Ashi, you still feel that it's noisy, sometimes for some of the spread, I switch to line chart. Okay, line chart will not show you anything. You only print the closing price. So it's very straightforward. If the line touches below, I will just buy. If it touches high, you will just sell. But look here, it's trading along the band. You sell, you will probably sell here. Then you got to sell again. Then you got to sell again. Then you got to sell again. And then probably here you cut. Then the fella come down. Okay, so natural. This is trading. Okay, similarly for the buy side. So sometimes changing it into line is clearer. Like for example, when I trade the XJX rubber, I use line chart. I don't need any candle because the fella don't trade that often. There's no candlestick pattern for me to read off. I just need to know the range that he has been doing. So he has been trading -1 to +1. Then I just keep trading that range. He goes to -1, I buy. It goes to +1, I sell. Or in between, I also can trade that kind of thing. So I use line, good enough. Okay, so you look into all this. Doesn't mean candlestick applies to everything as well. Some contract just doesn't trade, just doesn't have that flow, just doesn't have the chart pattern to look for. Okay, and if these things still don't work, there's another way. Also line, put in your support resistance line, Put in your MA. This is basically 50 against the 200. The rate is 200. The green here is 50. I'm sure all of you who traded TA wise, you know that there is already a dev cross over here, okay, which is some time back. I think this is in February. Yeah, February this year. And then there is also a dev cross situation over here, sometime back in 2021. So is this a repeat possible? So how do you trade it? Based on historical? Of course, historical doesn't guarantee your future success, but you have a reference here. It may just go sideways. It may not go down. And this BOPO spread usually trade in the good old days. It trades between par to 150 spread point in terms of US dollar per metric ton. 0 to 150. It oscillates within this range. So where would it go is likely it may just collapse and go to 0, but then it will still oscillate back between the par and 200 range. But currently at this moment, they are trading between the 300 to 400 range. So if it goes to 300, I will attempt a long. If I'm wrong, I will have to manage that risk. Okay, goes to 400, I'll attempt a short. And obviously the short side is a better side for me because why? The general big picture is a death cross, is a bearish market. So naturally, a bearish market, I wanted to be selling. Okay, but also not just the bearish market. The contradicting factor there is your term structure is actually in backwardation. So you are safer to be on the buy side when it's backwardation. So you have to watch that curve as well. If the moment that curve goes into contango, yeah, you know you want to be on the short side really. So your short will be very good. And this is likely to break the floor of 300 and then goes down to this trading range here. This is just pure charting kind of range view. Okay. Now, these are some references you can have. Those of you with Twitter, okay, you want to follow Bloomberg Commodity, Reuters Commodity. This lady here, American lady, very good with the agricultural kinds of posting, and she's formerly from, or maybe she's still a freelance Reuters journalist for the agriculture sector. Pretty good. I follow her to get some updates, and every now and then she posts very often. This other group is what I say is the company that provide the services for forecasting of weather and things like that. Because if I trade the US commodity, I need to know the weather there. I'm staying in Malaysia right now. I won't be able to tell what's the ground weather is going to be and change and things like that. So you need, when you trade commodities, you need to follow the weather. The weather will change the whole landscape. Okay. Now take home. This is the best part. Okay, I actually gone so much that take home. Where am I? Okay, whatever I'm going to present next can be cliche to some of you or probably all of you, okay. Your take-home question will be the fourth question that I mentioned in the podcast. Okay, is there a holy grail? How many of you here are still searching for holy grail? I think there will be, because there's a lot of new future traders here. You want to find what is the secret formula, what is the way to actually go about doing it. Trust me, I did that 13 years ago when I started into futures and was looking for the best formula, best chart, best platform, best candlestick pattern, the best of everything, that kind of thing. But as I mentioned earlier, I still blew up even knowing all the best. Okay, so so if those are still searching, and if you are new and things like that, I would say probably a good news is that you can stop your search. I already done all the search for you in the past already, so don't go and search anymore. If you trust me, of course. You have no choice but to trust me, right? Because I'm still trading today. Yeah. It applies. This one applies to everything. That's why it's called Holy Grail. It applies to everything. If you can internalize this and apply it to your life, I can rest assured you it's life changing. It changes my life as well. Okay, but I'm still not very good at it because I'm human. All right. The concept. Yeah, the concept itself. Okay, the concept itself. Right. So risk management. That's all it takes, the risk management. This is your holy grail, but it's not just risk management. It comprises all these things. Okay, what does it mean? Okay, trading is a business of probability. It's a probability game. You only can be a best guess scenario. Okay, you will never know. Nobody can tell you the next candle going to be bullish. Yeah, he can be lucky because you just have to call every candle. Next candle bullish. Next candle salah. Okay, next candle bullish. One Friday I'm going to get it right. Or one fine call I'm going to get it right. See, I told you it's bullish. Yeah, but you told me also bullish 10 hours ago, but then it collapsed. The kind of thing. So it's a best guess kind of thing, probability. So what's the hit and hit? Okay, hit is when you trade outright, especially, it's very volatile. Okay, you get whipped, especially when US market data release, FOMC, uh, inventory reports, and WASDE for commodity and all these things. All this report comes out, the market will just whip you. Okay, for no fundamental reason. They are just big boys there, will wash and rinse you a few times. They make enough money. Okay, go in the direction of the trade. Okay, so the hit. So you must be able to take the hit. Okay, if you can't take the hit, stay out of the kitchen. As I said, if you can't take the hit, the kitchen, get out. Okay, what is the other hit? Is when we trade, you need to have a trade plan, right? So your trade plan must have your stops, and most often than not, you get stopped out more often than you get your TP. Okay, it will stop you out before it goes to your TP. Usually that's the case. Okay, so what you don't want to do is to move your stops. Okay, to play around with your stop. That's a recipe for disaster. You don't want to do that. Next, profit is a function of capital. You want to make money, you got to have money in there. Okay, it's money finding money. So if you're not well capitalized, don't expect to have, I mean, there are people who say that I put in 5,000, I make $1 million kind of thing. Sure, there will probably 1 in 1,000,000 that can do that. But if really there is such a thing, you think he will tell you he's making million every time already? He won't tell you, okay? And for people like us, we are collecting $5 here, $50 there throughout the day. I'm just picking up peanuts or low-lying fruits. Anywhere I go, oh, there's a durian here. Okay, I take and eat. I'm happy with that kind of thing. And I collect this, accumulate this throughout the day, right? So you need to be well funded in order to trade, especially futures. Okay, futures is leverage. There's margin, lower margin, no doubt, but still the amount of contract that you can trade depends on your fund size that you have. So if you ask me, after now being professional trader for all these 5 years, the retail side, was I undercapitalized? Yes, I was undercapitalized. Again, remind me after we go out, the different type of instrument that you do trading, okay? The CFDs and all not, okay? So capitalization, I would say easily you would need, okay, even the US brokers who are asking for very low amount, you can start short. For practice, you can start any amount that's low. But be prepared that you're going to blow off this amount because you just cannot take the hit. Both of them, in fact, the hit and the hit. You just can't take the hit. Okay, then you need to decide with the fund that you have, decide your risk capital. You can do a percentage, which some of you may have learned, 2% of your capital for every single trade, or a specific amount. For every trade, I can only lose $200. No more than that. Anything more, that trade is not meant for me. So I keep looking for $200 trade. So you have lesser trade, yes, no doubt. But at least you're safer. Okay, you want to be able to live to fight another day. The market is always there. Okay, you blow up, you're done. You're out of the business. Okay. And position size you should be quite tough. Now CME gives you the micro and the mini and all that. The only thing you want to take note is if you're trading the mini and the micro, make sure that your cost of trade is low. You got to negotiate with your brokers to say that, hey, I can't be paying a full contract commission for trading a mini or micro because your tick size is different. Your P&L is different. It's so much smaller. It's probably 1/10. Instead of making $25, you're just making $250. So if I'm going to pay $10 commission, then what's the point? I'll be trading and pay to broker, okay, and worse, paying to exchange for the clearing fee as well. Okay, trade plans in all business, you need a plan. Okay, plan meaning you have to be comfortable before you take the trade. Where are you going to enter? Where are you going to TP? Where is your stops? Especially the stop, you need to be protected. Where do you want to get out? When thing goes wrong, what do you need to do? And when you have all this in place, you will take care of your emotion because why? We are all human. There's no way you can trade without emotion unless you're a machine. You are Robocop or whatever. Otherwise, the emotion is definitely there, and I still have it today. Okay, for fun sometimes, but really angry at times, okay, simply because you get stopped out, the fella go in your trade, of course you get angry lah, right? And then you TP and the fella go further, say you also angry lah, okay? Or fear, you don't have a plan, you don't know where you want to enter, you probably start chasing prices, which is fear of losing out, then, or fear of losing the profit because you didn't take your profit, the fella go back into loss. That's also not right. So you fear of losing a profit, you start taking profit too early, and then the fella take off. Okay, things like this. You will get into the emotion. Now, greed is the other one, which is actually not bad because that's where you would grow and make more. Okay, naturally we trade for money, so we want to make more. But this greed has to be in control. You cannot let it go ahead of you. How? When you have a winning streak, you say, I know how to do this already. I'm good at it. And you get complacent. You start forgetting your risk capital. And no need, I know how the market move. No need risk capital. Can risk all. Show hand, I can do it. Or position size, show hand. I trade everything what I have. Okay, I've been there. Okay, trust me, I've been there. So greed is good to make more. When you get into the sync of it, you get into the zone of trading the contract, then you can start to prepare to upsize. But of course, your capital fund is still important. You want to upsize, make sure your fund can support this plan. If cannot, top up your account before you upsize. Okay, and talking about this upsize, see, when we trade, let's say for example, I always trade for a 5 tick profit. Okay, 5 points, I take profit. And then that's one lot each time. And then when I upsize to 2 lots, okay, where do you think I should take profit? Someone give it a shot. I always trade 1 lot, 5 points. Now I want to do 2 lots. Where should I take my profit? 3, 5, 10, okay. No offense, okay. It's good to be greedy, but yours will be the most dangerous, okay. 5 is perfect. 2.5, a bit too conservative. Why? Okay, very simple. When you have been trading 1 lot 5 point, 1 lot 5 point, you are already in the zone already. 1 lot 5 point, 1 lot 5 point. So the next thing you do is just 2 lots. Okay, also 5 points because you know that 5 point. You are in sync with the 5 point kind of flow. So you still do your 5 point, but your profit is actually double because it's 2 lots. That's how you should step up your position sizing and not, in most cases, I've been there, seriously. 1 lot, 5 point, 2 lot, I want to go 10 point because I want to make even more because I know how the market move. And the 5 point I don't take, the fella goes down negative 5 point. I lost double. That kind of thing. It will always happen. So this is something you want to internalize it. Okay. So last bit, discipline, passions, and patience. Patience is easy. Very difficult to cultivate all this. You have to wait for your trade. You have a small fund size. You have to build up your fund size slowly. You make $50. Is percentage wise, it's a lot of money based on your fund size. You got to be happy with that. You cannot say only $50, cannot even buy a meal, that kind of thing. So you can't have this. You got to be patient to build this up. Okay. Discipline, whatever plan that you have, your stops that you have, please carry it out. If you're not in a good frame of mind, don't trade. Be disciplined, don't trade. If you need to go holiday, go holiday. I've been there as well. I'm supposed to plan for holiday. While I'm on holiday, I take out my mobile phone, I check the market. And then I lost money. Then the holiday gets sour. So things like this. So discipline. Passion. You need passion in order to go into this business, okay? Because the journey is very long, the hours is very long. Just like any business, if you're in a passion, the hours doesn't bothers you. Okay, it doesn't run you down. You can go the distance. That's why I can wake up 4 in the morning and trade till 11 in the evening with so little sleep. But of course, I take power nap in between the day when the market is quiet, or after lunch I take power nap. So all this is required, and yeah, I'll just continue. And I said at the very beginning, everybody must learn trading, okay, because it's a skill set that helps you to grow or at least keep you occupied at any point in time of your life as long as you are connected. Okay, now let's see Q&A. Okay, we can have the likes trend. Ooh. Okay. Oh, okay. Yeah. We do that question first. A quick one. Pick one or two.
Sure. So question
Wow.
1, for BOPO spread trading, how to determine should buy front contract, sell back contract, or should sell front contract?
Okay, I think you guys know how to answer this already. Right? How to decide whether to buy the front contract or sell the back contract, or sell the front and buy the back. Anyone? You know the answer already. You all have practiced already earlier. What do you see when you trade commodities? I think you know. You are so confident. I think you know. You should know. You should know. Come on, give it a shot. No harm. Just give it a shot. Don't be shy. You will learn very fast if you just sorry. Term structure. Perfect. Look at the term structure. Okay, if you don't know anything that you how you're gonna go about it, just look at the term structure. Okay, if your term structure is backwardations, your safer side is on the sell side. Okay, if it's contango, your safer side is sorry. What am I talking? Okay, if the term structure is backwardation, okay, you're looking at the camera, I kanchiong. Backwardation, your safer side is the buy side, and there's a contango, your safer side is the sell side. So something like this, it can help you to decide whether to buy or to sell. Of course, there are many more factors. You have to look into the production numbers. Which month are you literally trading? How is the situation globally? How is the situation for your competing oilseed market? All these are factors that will affect the price. Okay, next.
Yeah, the second question is, could the term structure of FCPO help us to decide long or short a butterfly spring?
What do you think? Can term structure help? Come on, guys. Sorry. Two term structure, not necessary. Term structure, there's only one. Okay, what you're not wrong. You're not wrong. I know you're getting there. Okay, term structure, there's only one, because term structure refer to the outright prices, right? So how do you trade it on the butterfly? Basically, you just have to plot the butterfly settlement price. Then the butterfly will have a curve by itself. It's a forward curve. Okay, we don't really call it a term structure because the term structure refers to the outright price. So if you want to trade a butterfly, plot the butterfly curve. Okay, unfortunately, I don't have it on screen. Yeah, well, I do have the butterfly curve. I have the single month spread curve. I have a dual month spread curve. I have odd month spread curve. You just have to plot the price. And then when you plot the price, you know where are they trading basically. Basically, you just collect your data of settlement, okay, for that specific contract month. Let's say right now your active month is August, right? So at the end of the day, settlement price for August is one price tag there. September will be a next price tag. And then October is the next price tag. So this form your outright term structure. So for August butterfly, probably trading at August butterfly should be at about, what is August doing now? 30 over points, I think. Probably, say 35. September butterfly is trading at, say, 15. Then October butterfly is trading at 3 or par, 0. So you know your butterfly curve is actually sloping downwards. The August is higher, September is lower, October is lower. So if you want to buy, which one would you buy? August, September, or October? Which one will you buy? Always use the basic. You'll buy October, because why? It's lower compared to August. So you can sell the August butterfly and buy the October butterfly. So you are spreading a butterfly against a butterfly. Be careful. There is 8 lot at one go. A round turn is 16 lots. So you got to calculate your cost. It's costly, but it can be done as well. Okay. Okay. That's all for online. Wow. Either I'm very good or I'm 2 questions only. Any question from here? Yes. Okay. Right. Good. Okay. I need crystal ball for that. But yep. Okay. So a good question there as well. The question is, if the contracts, the spread widen, okay, when do I decide when to sell this contract when it's widened, when to sell it or when to buy it? Okay, where specifically, how wide is wide, how narrow is narrow to do my trades. Okay, my personal experience is such that you need to be, of course, you need to do all your risk management. All this has to be in place. Of course, like I said, this is your holy grail. Once you internalize this, then you will be thinking the next stage. The next stage is, where are the range that I'm comfortable to trade within? Okay, where is the range? Let's say, let's say we refer to a spread, pump spread, for example. Okay, if let's say the spread is at, say, whatever the spread is, trading at 200 points. Okay, the spread is trading at 200 points. Is 200 points the level that you're comfortable to manage? Because why? Can the 200 point go to 300 point? Yes, it can. Okay, can the 200 point immediately come down to 100? Yes, it can. Can the 200 point don't move? Yes, it can. That's why I say your risk management, once you internalize this, you know exactly what's going to happen. Then if your 100 point move upward is comfortable plan for you because you have a totally different plan, after that, then take the 200. You got to make a call. Okay, you need to trigger. You cannot say, I think 200 is a good price to sell. But when the price really come to 200, no, I go to 300. Then you keep moving away. And then the fella don't go to 300, you go to 250, it come back to 200. Then you move back down to chase the price again. Then what are you doing? You're not trading. You're just playing with the fella. You want to catch me? Oh, come nearer. Hey, don't run, I catch you. That kind of thing. Then you will never get your trade. So you need to decide at a certain point, where is the range that you're comfortable based on your risk management. As long as your risk, let's say the 100 point move is way below your 2% capital funding or the risk capital, by all means, man, do it because it's way below. And depending on your trade plan, your strategy with it, whether is it a mean reversion kind of plan that you're trading, or is a directional kind of plan that you're trading. If your mean reversion 200, I trade 300, I trade because I know it's going to go mean reversion because it is a mean reversion behavior. So you need to know how the contract behave. Then you'll be comfortable to do at the level that you want to do. So there is no absolute sure thing that, okay, at this price you sell, sure make money. No such thing. Okay. Right. Right. Okay. Yep. Again, again back to, okay. Can I share my chart again? The last one, the risk management. Okay, how to determine? Again, you really need to internalize the risk management part of it. Okay, your capital is the most important factor. Your risk capital, the last one with the risk management take home bonus thing. Yeah, this one. So your risk capital is the most important part of it. You don't want to lose more than you could afford to lose. Okay, so if your fund size is so big, okay, for that matter, no matter how big your fund size, if you have 10 million, you are still limited to 10 million. So you got to be realistic. Don't say you have 10 million, you're very big. No, there's 100 million behind you. There's somebody with a billion, that kind of thing. So nobody's size is big enough for the market. The market will take up everybody if they want to. So again, it's your risk comfort level. If your risk comfort level is only up to there, sometimes you will end up being painful. Like say you start to short 200, it goes 300, you short. It goes 400, you short. And it goes 500, you short. Goes 600, you cut. You lose everything. Very painful. Yeah, very painful. Because if then you realize, then you come to internalize how far beyond is where my limit cap is. Once you goes to the limit, you want to get out. If you get out and the fella goes back in your flow of trade, you have the rights to be angry, but you have to internalize this. Okay, because it can happen. Because if you don't cut, the fella go to 1,002. It's even more painful, right? So this is, I can't tell you the exact specific because why? You are different from me. Every one of us is different. That's why I say you don't want to trade alone. You want to trade with a buddy, at least one tech partner, so that you can discuss and then you hear his view. Then you internalize it yourself. Okay, am I comfortable? Are we in the same page and things like that? If not, then the first cut is always the best cut. Okay, that's why stop is important. You sell 200, my maximum loss 50 bucks. At 250, if it goes there, I cut. Then what do? I wait to sell 350, another 100 bucks up, see whether you come. The fella come, wow, feel me, 350. Then another 50 bucks, 400, I cut. Again 50 bucks, I cut. Then what do? I wait 600 this time now, 200 bucks more. The fella come, feel me again. I say, okay, you feel me again, I do again. Okay, 600, it goes to 650, I cut. Then the fella go all the way back down to 100. So you bang, but can't help it. See now, easy to say. You cut, you go back in. You cut, you go back in. How many times can each one of us, because we're human, you cut and cut and cut and cut. Okay, I have one professional trader ever told me before when I was still retail. He says, cut, and your money will come. So I learned that. I say, okay, cut, money will come. So when I'm wrong, I cut. When I'm wrong, I cut. When I'm wrong, I cut. When I cut, I cut. So yeah, that's the question. That's the question. At the end of the day, I asked myself, and I was wondering, you tell me cut and the money will come. I cut, but I lose more. My account getting smaller and smaller. Money never come. Okay, there is a difference. That's why I trade so many contracts. Nowadays, when I cut, I'm okay. I just cut. Sometimes big losses like this kind, I average, and then it's so big, so painful. I cut because it's just way beyond me, Eddie. Way beyond what I can take. I can lose in a trade 5-figure. I just have to cut it off because it's painful. Yeah, cut it off. But you have to make it back. Where do you make it back? Because you have you cast your net wide. You have so many contracts. Don't fight back on the same contract because your view towards that contract is totally wrong already, no matter what. Because some will say, okay, so some myself is wrong, right? So I cut, and then I turn long. So the moment you cut, you turn long, the fella turn short. Also jialat. So how? So for me is, if I cut, I stay away from it because I'm just not in sync with you. I stay out. I look for other trades to do. Yeah. I change my perception. If I lost in pump, I stop pump. I start looking at rubber. Hey, rubber so nice to me. Okay, I got like $50 here, $15 here. Small peanuts cannot cover my loss, but it's okay. It built back your confidence. Okay, because when you have a big loss, it really damage you quite bad, especially psychologically. So that's why you don't want to get into big losses. Cut as much as you can, as much as you can. Cut as fast as you can so that you keep your losses small. Okay, and then your trade plan. Basically, it still comes back to your trade plan. There is no one formula or one specific way of doing it. Every contract is different. Now, he reminded me one point which I didn't mention about BOPO spread. Nice, quite simple to do and things like this, but spreads like this are called exotic spreads. Okay, what do you mean by exotic? It's really very exotic. Like you go to exotic resort, right? You go there and like, wow. So you look at it, it's like, wow, so much money to make. But it's not easy. It's really not easy. You need a lot of time to practice. You need a lot of time to get into the zone to be able to communicate with it. As in, when you put the Bollinger Band, when it comes to the low band, you buy. Will you buy? So you got to understand the fella. You want to take the chance. This is where it comes in. It already hit the bottom of the band. So my plan is at this level, at this bottom of the band, I take a shot. If it goes down, I get out because I'm wrong. I'll buy lah because I wanted to buy low and I wanted this level. Okay, for example, I'm saying it's trading at between $300 to $400 right now. The range is there. Okay, it goes to 300. I want to attempt. So it breaks the 300. I want to get out because it's wrong because it's broken. And if you go back and put in this chart again, you can see that not this chart. Basically, if you put call out your bean oil chart, the bean oil chart actually you could also see this is individual again. You probably can see a head and shoulder there already in the bean oil chart. Okay, a continuous bean oil chart, you can see the head and shoulder, and it's at the neckline right now. And left line, it should have broken it already. So I've also taken head and shoulder pattern before, euro dollar, the currency. Head and shoulder, it breaks down. The moment I put in the trade to short, the fella goes down. I make 800 bucks at one go. Wow, very happy. The next day, I just leave the trade there because head and shoulder, the head distance is exactly where your TP is. So I waited there. So the next day, the fella punched back up to the neckline, above the neckline, and then he trade back up bullish. And in the end, I lost 18,000 for that trade. So things like this. This is what I have gone through. That's why I told you, you don't search for the holy grail anymore. There's no such thing as holy grail. Head and shoulder pattern trade is a holy grail. Yeah, it is. I lost money in head and shoulder. So it has to come back to this risk again, risk management. It's all about risk management. Mm. Mm. Yeah. How much money do I have? Yeah. Yeah. Even if I have a lot, as I say, if you're 10 million, how low can you support? The market is always bigger than anybody combined. You see central bank intervene with the currency thing. Are they always successful? Hardly. Because the market is so big, especially the Japanese central bank. They always support their yen. Okay, it move when they're supporting it. The moment they got no more support there, any bam, the whole yen will come back again. Because the market is so huge. Nobody is bigger than the market. Okay. Any questions? Yes, sir. Stop buy and limit buy. Are you referring to this? Okay, so it all depends. It all depends on the contract that you trade. Most of the time, I do limit buy. Limit buy, limit sell. I don't do the stop buy, stop sell. Stop buy, stop sell means you actually hit the next level higher to trade. These are usually for the momentum trader. When the momentum start coming up, they buy the next tick higher. They buy the next offer so that to take the momentum along. But these days, because the algos are there, this kind of trades is no longer that profitable anymore. Most of the time, it's a fake out. The bullishness comes in, they fake you out. Okay, you do the buy, and then they will turn you back down to take out your stops because your stop will be right below it. They will come back down and take off all your stops because there are people paying to get all this information. If they see a lot of buying above the breakout and there's a lot of stop below, for them it's simple. I just have to dump some money. I go there, I sell you. You want to buy, right? I sell it to you. Then I push your price down so low because I keep selling the bid. I push it so low, then I cover back everything. I would have made back all your money because I know you're there as a stop. I can sell you there as well. And then when I take away all the stops, there's nobody holding the floor anymore. What happened to the price? Bam, it goes down lower. Yeah. So if you don't put your stop, you get short. That's why I said stop is important and honor your stop. Yeah. So and then for the big boys, they will just clear off the stops, crash the price down, buy back and make all the money. Plus your stop money as well. Yeah. Okay. Yes, ma'am. I wouldn't say rule of thumb, but then I would say in general to get you going, depending on how many contracts you want to trade, the strategy you want to trade. Like for example, if we were to do what we do, okay, I would say those that who have gone through our courses and would like to do what we do, the amount of contract and all that, minimum you will need at least 100,000 Sing. Better is 100,000 US. That is the what they call baseline that you're comfortable. You're not going to do a lot. You're not going to use up the whole 100,000 kind of thing. You're going to have enough buffer to trade and learn the strategy, to trade the contract, to get in sync with the market, to understand the contract. So you need a higher capital fund size so that you can buffer your trades, because trade can go against you. Yeah, so go against you, you take your 2% as your stop loss. Yeah, and then you basically decide whether you want to take it out or you want to change your plan or something like that. So you need that base for the market with the hit and hit kind of things, right? To apply strategies. Yes, sir. Yeah, 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 yeah. When you start with future contract, it's always one lot. Any contract, one lot. Because yeah, you need to understand the contract, because and that is the lowest you can do, unless you trade the mini and micro contract. Then you can actually do two minis, two micro, three mini, three micro. Okay, usually when we talk about those mini and micro contract, when it's small contract, you can actually like to do in batch of three. Each time you do three lots. Okay, why three lots? Three lot is still less than your standard one lot. Okay, three lots because then you can also split these three lots to three different levels. You don't buy all at one level. You split into different level because your study is this range. It's never an absolute level. It can always go into a range. So you split out in a three lots range. It may not take up all your 3 lots because it trade only 2 levels of yours, and then it turns back up to wherever you want to go. And then you miss the 3rd lot. Doesn't matter. I still have 2 lots. So for the 2 lots, I want to take TP for the first lot. If possible, my TP for first lot that I take enough to cover back my cost for the 2 lots. Then my 3rd lot and my 2nd lot become a free lots for me, which I can write. And how do you write? Of course, trailing stops. Okay, hard stop to begin with. Okay, a comfortable range. When you have the hard stop, okay, once the trade goes in your favor, you want to at least move to your entry level plus maybe 1 tick to cover your cost of trade. So at least you will lose time. You will not lose money. You're protected. Okay. The worst thing is you're already making money. Then you didn't trail a stop up to entry. The fella go back down. You're in a loss. You take out as a stop. Your stop level. You lose money instead that trade. So how you fine tune that? You want to trail your stop to entry or slightly more to cover your costs. And then you keep trailing. And where do you trail? Again, is individual. You can trail based on the trade flow. The next lowest low, the next swing low, something like that. You start trailing there. Because if you take out a swing low or a swing high, means the strength is in that direction. So the swing low or swing high will be a good level for you to trail your stop, be it you buy or you sell. Right? So you split into mini lot, micro lots, 3 lots, and you keep doing 3 lots. And then you can play around with where you take profit. You don't have to take all at one go. You do 1 lot, I go in, take profit, that's it, I'm done with the trade. You got to look for new entry again. And sometimes with the momentum, it's sometimes very difficult. As a bullish market, it's very difficult to take the next entry because the price is going higher already. Are you comfortable with that price again? Then you got to look for a new setup, a new pattern that you're going to trade before you're able to go into the next entry. Okay, so I believe we need to adjourn. The food is cold and things like that. We can talk outside. I'm here. I will be here for the next 2 years, so you can still get me. Yeah. Okay.
Yeah, so thank you everyone for attending the webinar or seminar today, and also thank you for our speakers today, Canal. Yep. So yeah. Yeah, so basically, I would just letting you guys know we do have a few branches and some social media in here lah. So if let's say you want to recap back the recordings or our previous webinars or seminars, we do have uploaded in our YouTube. So you just search Philip Capital Sendirian Berhad. You can find us in Facebook, YouTube, LinkedIn, and also Telegram. By reaching out this platform, we due to time we will share those data in the Telegram groups. So you just follow up our Telegram groups and get in touch with us. And not only that, we do have Instagram or also our official website. So if let's say you are interested to open an account with us or what, you can go to our website and do everything self lah. So here is our contacts. And if let's say you are attending the seminar today, we do have a name card on our side. If let's say you want to have further inquiries or more, you do reach out to us lah. And if let's say you are staying online, so here is the contact you may find on. Yep. So thank you all for joining today and have a good day. Thank you. Bye bye.